Good morning or good afternoon, depending on where you are joining us from. My name is Sharon Kozicki, and I'm an advisor with the Banque of Canada and will be your Master of Ceremonies for the conference today. We're very happy to host you for this 2020 Inflation Target Renewal Conference towards the 2021 renewal of the Banque of Canada's Monetary Policy Framework, a discussion on current research and lessons from the COVID crisis for monetary policy. I would like to begin by acknowledging that the land on which we gather is the traditional, unceded territory of the Algonquin people. As part of the 2021 renewal of the Banque of Canada's Inflation Control Agreement with the Government of Canada, bank staff are currently comparing several monetary policy frameworks. The primary goal of this day-long workshop is to share and receive comments on these comparisons. The workshop will also examine lessons learned from the response to the COVID-19 economic slowdown regarding alternative monetary policy tools, complementarities between monetary policy and fiscal policy, and macroprudential policies. It will consist of a series of lively and thought-provoking discussions. The invited audience includes academics, private sector economists, financial market experts, and representatives from policy think tanks, other central banks, and Bank of Canada staff. Without further delay, it gives me great pleasure to introduce Senior Deputy Governor Carolyn Wilkins, who will commence with the opening remarks. Carolyn Wilkins, appointed Senior Deputy Governor in 2014, oversees strategic planning and the economic and financial research of the bank, and shares responsibility for decisions with respect to monetary policy and financial stability. She also oversees the bank's analysis of international economic developments in support of monetary policy decisions and serves as the bank's G7 and G20 deputy. Ms. Wilkins represents the bank on the Financial Stability Board and is a member of the FSB's Standing Committee on Assessment of Vulnerabilities. She's a member of the International Monetary Fund's High-Level Advisory Group on FinTech and chaired the FSB's FinTech Issues Group. Please join me in welcoming our Senior Deputy Governor, Carolyn Wilkins.
Merci beaucoup, Sharon, pour cette introduction et bonjour tout le monde et bienvenue à notre colloque virtuel. Thank you all for joining us at our workshop on the renewal of the Bank of Canada's monetary policy framework that's set for 2021. It feels like it's just around the corner, and that's pretty amazing. But bank researchers have made a lot of progress in their research on all the topics that we're covering since we kicked off our work plan in 2018. Of course, that seems like 1,000 years ago, given the current health and economic context. But at that time, I laid out the main challenges that are confronting us at a speech that I gave at the Max Bell School of Public Policy. Now, that school is going to have a conference on monetary policy frameworks in September, and we're looking forward to that. So one of the challenges that I laid out in that speech was something that has become crystal clear today. And that's that central banks are likely to run out of conventional firepower if we see an economic downturn in this low interest rate world. Another challenge is that long periods of low interest rates encourage investors to take on risk that may be excessive. Now, we see that today with high levels in indebtedness. In Canada, we've talked a lot about that, but also around the world. And if you look at the data, you'll see that debt to GDP worldwide is nearly 350%. That's much higher than at the time of the global financial crisis. These challenges have led us to focus our research on three questions. The first is the most obvious, and that's, is there a framework that we can articulate that's different and that will do a better job than the IT framework that's been in place for more than 25 years? Well, to answer this, we're running a horse race among alternative frameworks for monetary policy. I find this part pretty exciting because in addition to our current framework of inflation targeting, The other frameworks that we're looking at are targeting an average inflation rate of an average of inflation more than 12 months, or targeting the price level, targeting nominal GDP, either growth or the level. Another possibility that we're looking at is a dual mandate that targets both inflation and employment. We're evaluating these frameworks against a clear set of criteria. Most obvious is we want to see how well these frameworks can achieve stability in terms of the economy and in prices so that businesses and families can make their decisions with more confidence. We're considering the implications of these frameworks for accountability, communications, credibility. And we're also looking at more novel criteria, how each framework impacts the distribution of wealth and income, very important topic these days. How robust these frameworks will perform, or how robust they are in good times and in bad times. Now, you're going to hear more about the results of the horse race later. The second question that we were looking at is, how can the Bank of Canada's toolkit support whatever monetary policy framework that we end up choosing? To answer this question, we're studying how the tools that the Bank of Canada recently introduced have impacted both financial markets and the real economy. I can say that in 2018, I wouldn't have foreseen that we would have deployed so many of our tools in response to the global pandemic. I'm pretty grateful, though, that staff have done so much advanced legwork that it meant that we were ready to respond to the pandemic very quickly. The final question that we're looking at is, how can other public policies work together with monetary policy to achieve sustainable growth and price stability? Like other central banks, we're closely following research that examines how monetary policy interacts with fiscal and other public policies. You've undoubtedly noticed that we have a live experiment in motion on how monetary policy and fiscal policy can complement one another during a crisis. Now, the purpose of today's workshop is to discuss what we've learned so far from the considerable research that's being produced by our staff, and also to gather your views on these research questions. Our discussion with you today is just one of the several ways that we're seeking feedback. Just this week, we launched an online public consultation to gather Canadians' views on the bank's approach to monetary policy. And I heard that already we've had more than 3,000 responses to that survey. Les avis du public, tout comme les résultats des consultations menées auprès des divers groupes, représentent les consommateurs, les milieux syndicaux, les entreprises, les communautés autochtones, la société civile et bien sûr le monde universitaire. Et ces consultations viendront enrichir la réflexion de la Banque sur le meilleur cadre de politique monétaire pour le Canada. So we plan to publish a report on what we've learned sometime this fall. Today, we want to hear your comments and advice so we can make sure that the evidence that we bring to bear is robust and it's thorough. But before we begin the day, I'd like to reflect on the early impressions of how well the current monetary policy framework has served us during the pandemic. First, the fact that we have a clear and simple framework is golden. We have a clear target, that's 2% inflation. And that means that businesses and families know what we aim to achieve with our actions. Central banks, especially these days, need to be transparent. Our inflation target is 2%, and it's defined in terms of the annual consumer price index, and it's simple to see if we've done our job well or not. Second, our framework is flexible in terms of how fast we aim to return inflation to target. And that's important, this flexibility, because it means that we can consider how well the job market is doing when we are determining how quickly we want to return inflation back to target. Flexibility is also useful in circumstances where returning inflation back to target more slowly could help support financial stability. Third, I'm struck by how far we've all come in our understanding of the limits of monetary policy to solve all problems. This has increased the focus on how fiscal policy should contribute to stimulating growth and how structural policies can increase long-term economic prosperity for Canada. It's also underscored the important role of macroprudential policies in helping to avoid a buildup of financial vulnerabilities when interest rates are low. And by macroprudential policies, I'm talking about the usual suspects, mortgage stress tests and others that are there to support sound underwriting practices through a cycle. So let me just be clear here. Monetary policy is ill-equipped to deal with sector-specific issues. We need to take them into account in our monetary policy decisions, that's for sure. But our focus must be on the macroeconomy to support sustainable growth and price stability. In the current context, coming out of such a severe hit to jobs and to economic activity, the bank must keep its eye on the ball. Unfortunately, there are many other policies that are well suited to deal with sector-specific issues. All of this just highlights the challenges of policy coordination, and it also highlights the importance of central bank independence. The central bank, the Banque du Canada, other central banks are deploying an array of monetary policy tools to support the economy and the financial system in response to the pandemic. The bank has been very clear that our efforts, including quantitative easing, are in support of our monetary policy objective, and ultimately the economic and financial well-being of Canada. That said, there is one area where I think we need to dig in more, and it's related to the measurement of our target, the CPI, the Consumer Price Index. We started our in-person public consultations last year, and we heard loud and clear that the measure of inflation needed to be considered. And quite frankly, that's because many people feel that inflation is higher than the one that we've measured. And that's why we started working with Statistics Canada last year to look for ways to improve the Consumer Price Index. Now, Deputy Governor Chambry spoke about this yesterday at the Canadian Association for Business Economics. This work continues now at an accelerated pace because of COVID-19. COVID-19's just only exacerbated this perception of higher inflation. The intuition's pretty clear. I mean, some prices, like those on travel, are falling, but travel's not really relevant to most people these days. Other prices that are rising, like the cost of food, are ones that people encounter every week. Now, the price of meat, just to give you one example, so the price of meat has risen by more than 4% since February, and that's before the pandemic really hit in Canada. Well, that doesn't feel like low inflation to me, and it doesn't feel like low inflation to many others as well. Yet when we look at the measure of inflation in its altogether, it's close to zero when you consider the full basket of goods and services. It's just critical that we measure inflation as accurately as possible so that Canadians have confidence in our target. And we must address public perceptions in our analysis and in our communications. Now, the morning session will compare monetary policy frameworks and provide an update on the horse race. It's a big topic, and so we split the session into two parts. Reese Mendes will start with an overview of how our side-by-side assessment has progressed. I can tell you right now, we've identified some of the strengths and weaknesses of different frameworks, but at this point, no single framework dominates on all of the margins that we're looking at. After the break, we'll continue with the session with a discussion of the horse race, and it'll be led by Joseph Gagnon from the Peterson Institute for International Economics, Pierre Fortin from the Université du Québec à Montréal, and Stephanie Schmidt-Grohe from Columbia University. At lunch, you're invited to watch a video which Deputy Governor Larry Chambry put together that discusses our inflation renewal process and how it compares to other advanced jurisdictions. After that, we'll break into small groups for more discussion of the results of the horse race. Now, session 2 in the afternoon examines the issue of policy coordination that I talked about, and especially policy coordination at a time of crisis. Ceremonies is going to chair this one with discussions by Ricardo Reis of the London School of Economics and Marty Eichenbaum from Northwestern University. Now, finally, we'll close the discussion with the alternative tools that I mentioned earlier and lessons from the COVID-19 crisis. Leading the discussion will be Ed Devlin, formerly of PIMCO, Annette Vissing-Horensen from the Haas School of Business at Berkeley, and Anil Kachap from the University of Chicago Booth School of Business. Now, seeing these extended monetary policy tools in action during COVID-19 has put renewed focus on exactly how are they impacting asset prices, as well as decisions of borrowers and lenders. Of course, we need to discuss the side effects that we're most concerned about and explore ways where we can improve these tools without undermining their effectiveness. J'ai hâte d'entendre vos contributions à la discussion parce qu'elles vont influencer à coup sûr la suite de notre démarche. I'll return to the virtual stage at the end of the day to sum up the takeaways and what that means for our work going forward. So let's get going. I'm looking forward to a lively and constructive discussion, and I'm pretty sure that's what our participants will deliver. Thank you.
Thank you, Senior Deputy Governor Wilkins, and good morning or good afternoon. My name is Anthony Landry. I'm a Senior Research Advisor at the Banque of Canada, and I will be moderating the first session titled Comparing Monetary Policy Frameworks, an update and discussion of the horse race. Joining us for the first part of this session is Riz Mendes, Managing Director of the International Economic Department here at the bank. Riz will present the result of our internal comparison of several alternative monetary policy frameworks. This is an important input into our process for renewing our monetary policy framework in 2021. We have allotted 30 minutes for the presentation and 20 minutes for questions. We encourage questions from the audience during the presentation. To do so, please send your question using the chat function on the right-hand side of your screen at any time during the presentation by typing it in the chat box and directing it to all panelists. Questions will be compiled and asked after the presentation by Sharon Kozicki. My colleagues are adding this instruction in the chat box now. Then, in the second part of this session, at 11:20, we will turn to our three distinguished discussants, who will then share their thoughts on our internal comparison of alternative monetary policy frameworks. Now, I would like to turn things over to Riz Mendes. Riz?
Thanks, Anthony, and good morning, good afternoon to everyone listening in. So let me just grab this clicker. So as Anthony said, I will present some interim results from our horse race of alternative frameworks. But let me just start by saying a couple of things. So first of all, I wanted to note that the work I'm presenting today is based on the contributions of many Bank of Canada staff. There are too many for me to name all of them, but I do want to acknowledge that I'm merely presenting their work. They're the ones who did the real work here. And secondly, I just wanted to note that this work is independent staff research. So the Bank's Governing Council established the questions for the review, but the staff go about conducting the analysis independently. And so while the analysis will be an input to the decision process, at this stage, it doesn't represent official Bank of Canada views. Our goal here is simply to share the work in progress in order to get feedback to help improve it. So with that, let's get started. So if you can see from this chart that monetary policy frameworks really do matter for macroeconomic outcomes. The chart plots inflation back to 1915, and it's immediately evident that inflation targeting has been extraordinarily successful at stabilizing inflation. But while it has been very successful, there are now some important challenges that Senior Deputy Governor Carolyn Wilkins just mentioned. So, as Carolyn noted, there are two challenges in particular that motivated the questions for this review. One is the fact that we have a lower neutral rate of interest and therefore less room to maneuver. And the other is that there are greater trade-offs with financial stability in this low interest rate environment. So you can see the decline in the neutral rate in this chart. The blue shaded areas show how our estimates of the neutral rate have evolved over time. We've plotted the neutral rate estimates only since the mid-2000s, but clearly interest rates have been declining since the early 1980s. And although much of that decline in the early years was due to declining inflation expectations, a significant portion was also attributable to a declining real neutral rate. So today I'm going to focus on the first of the three research questions, and I'll talk about some of the work we're doing as part of this horse race of alternative frameworks. I should note that while I'm going to focus on our current work, there are important lessons in the broader literature, and those will feed into the overall assessment, though I won't have time to do a full literature review today. So in terms of the horse race, the first thing you need to have a horse race is, of course, horses. And in our case, the horses are the alternative frameworks that we're looking at. Now, you wouldn't bet on a horse that could only win on one track. And so we want to evaluate the horses, the frameworks in this case, on multiple tracks. These multiple tracks take the form of different economic models, laboratory experiments with real-world people, and the consultations that Carolyn mentioned. Now, of course, in a real horse race, it's easy to judge the winner. The winner is whichever horse crosses the finish line first. Our horse race is a bit more complicated, so we need a set of criteria by which to judge the winners and losers, and I'll talk about that also in a moment. So let's talk about each of these three elements of the horse race. So starting with the horses, we're looking at six different frameworks. I'll talk more about each of them as we go through the results. At this stage, I just want to note that the frameworks differ from one another in a couple of important dimensions. So first of all, there's the degree of history dependence in a given framework. So I'll come back to this more later, but let me briefly tell you what history dependence means in this context. So start with the case of inflation targeting, which doesn't really have much history dependence. Under inflation targeting, bygones are bygones. So if you miss the inflation target in one period, it doesn't change what you try to achieve the next period. You're always trying to get inflation back to target. In contrast, under a more history-dependent framework like price level targeting, you try to make up for misses. So if you undershoot inflation today, you try to overshoot tomorrow. And this error-correcting behavior can be helpful in certain situations, in particular when there's a low neutral rate, and you hit the effective lower bound on nominal interest rates, because it can create expectations that interest rates will remain lower for longer after a negative shock and automatically provide some additional stimulus. The downside of history dependence is that it can lead to greater volatility in output if people don't have fully rational expectations. The second dimension on which the frameworks differ is the degree of emphasis on stabilizing a real variable. So under the current IT framework, stabilizing a real variable is an important consideration, but it's not an explicit part of the framework. As part of the horse race, we're looking at variants like nominal GDP targeting and the dual mandate that Carolyn mentioned that would make the emphasis on a specific real variable more explicit. Placing more explicit emphasis on stabilizing a specific real variable may help to stabilize the real economy, but it could also have unintended side effects. So for example, an important feature of the current framework is its simplicity. The focus on the 2% inflation target has helped to really strongly anchor inflation expectations in Canada. And this strong anchoring of inflation expectations has given the bank the flexibility to take account of things like variations in output, employment, and financial stability. If a second objective were added to the framework, could it potentially weaken this anchoring, and would that paradoxically necessitate an actually greater focus on inflation? Those are questions that we need to think about carefully. So in terms of the tracks, we're using a number of different methods to evaluate the frameworks. I'm not going to be able to discuss all of them today. In part, this just reflects the fact that much of this work is still ongoing. So I'm going to spend most of my time talking about the results in our benchmark model, Totem. I'll also talk about the results from some of the laboratory experiments that we're doing with real people, and I'll talk about some results from some of the alternative models that we're using. I will not have the opportunity today to get much into the issues related to financial stability or the implications of labor market hysteresis or non-vertical long-run Phillips curves. These are all important issues that we are looking at, but I won't be able to talk about them in the presentation today as the work is still ongoing. And then lastly, in terms of the criteria. So we're going to evaluate the frameworks using a broad set of qualitative and quantitative criteria. Today, I'm going to mainly focus on the macroeconomic stability and robustness criteria, and I'll touch upon the distributional implications of the different frameworks. The ongoing work that I mentioned is going to help to inform a number of the other criteria also. And I should note that the work we're doing builds on work we've done for past renewals. In particular, we had looked at price level targeting in 2011, and we looked at raising the inflation target in 2016. Since we did that work, estimates of the neutral rate have fallen further, and so it's important to revisit these issues. I won't present any new work on raising the inflation target today, but we are conducting new research on that. So let me now start with three frameworks that are closely related: inflation targeting, average inflation targeting, and price level targeting. So these frameworks are related in the sense that each involves targeting some derivative of the consumer price index and the way we set them up. So inflation targeting targets a 12-month rate of inflation. Average inflation targeting targets some longer average of inflation, a multi-year average of inflation. And price level targeting targets the level of the price index. And the level of the price index is the cumulation of all past inflation rates. And so these different frameworks have different degrees of history dependence. As I mentioned earlier, under inflation targeting, bygones are bygones. Don't try to make up for past misses, and so you get base drift in the price level. At the other extreme, under price level targeting, you try to fully offset any misses, and so the price level is stationary. So let me show you what that looks like. So this just shows you a sort of stylized disinflationary shock. So under IT, the disinflationary shock is followed by a return to the 2% inflation target. In the right panel, we see that this leaves the price level permanently below its pre-shock trend. In contrast, under price level targeting, the disinflationary shock is followed by a period in which inflation overshoots 2%. This overshooting in inflation returns the price level to its pre-shock trend. In order to generate this type of overshooting, though, interest rates have to remain lower for longer than they would under the inflation target. And this is actually beneficial in certain circumstances because it means that it automatically generates lower for longer interest rate expectations that can help to support the economy, particularly when the lower bound on nominal interest rates is binding. Average inflation targeting, where you target some longer than 1 year but finite average of inflation rates, ends up sitting somewhere in between inflation and price level targeting on these margins. So you partially undo the shock to the price level. So when does history dependence help? There are at least two situations where history dependence can help in terms of stabilizing the economy. One, as I mentioned, is at the effective lower bound. When nominal interest rates can't fall any further, the commitment to correct past misses creates an expectation of lower for longer rates that provides stimulus. And then the other situation is in response to shocks that generate a trade-off between inflation and the output gap. So, for example, consider a positive markup shock. This raises inflation but tends to reduce the output gap. A commitment to stabilize the price level reduces expected inflation in this situation, and therefore helps to mitigate the initial size of the impact of the shock. And the lower inflation expectations, since they partially offset the initial impact of the shock on inflation, reduce the need for an initial decline in the output gap. And so overall, it helps to stabilize the economy in response to shocks of this type. So let me start with our benchmark results. So we produce our benchmark results in Totem. This is one of our main policy analysis and projection models. It's an estimated DSG model with a number of features that are designed to capture important features of the Canadian economy. These include open economy features, multiple sectors, staggered nominal wage and price adjustment, and a relatively high degree of rule of thumb behavior in wage and price setting, which will turn out to be quite important for our results. So we characterize the different frameworks in Totem using simple policy rules. The rules react to both the targeted variable, be that inflation, average inflation, or the price level, and the output gap. In the simulations, we vary the coefficients on the targeted variable and the output gap, but we hold the smoothing parameter fixed at 0.85. We fix this parameter in order to avoid confounding differences in the degree of history dependence embedded in the target variable, with differences stemming from the degree of interest rate smoothing in the rule. So we also make several other key assumptions. In particular, we assume that the nominal neutral rate of interest is 2.75%, and the effective lower bound is 0.25%. So this means that the policy rate can be cut by about 2.5 percentage points from steady state before it hits the lower bound. And for the extended monetary policy toolkit, things like quantitative easing and other elements of the extended monetary policy toolkit, we consider two polar cases. So in one case, the ELB is not a constraint, and we interpret this as a situation in which the toolkit can completely compensate for the ELB. In the other case, we assume that the ELB does occasionally bind, and there are no other effective tools available. So these are sort of two extremes. Reality likely lies somewhere in between, where the extended monetary policy toolkit can partially compensate for the effects of the effective lower bound. And we have in the past actually tried to explicitly model those extended tools, and we are doing that work now. But I think the two polar cases helps us to establish some bounds and yields information on the robustness of the alternative policy frameworks to the assumptions about the extended toolkit. So let me start with some of the results. So this chart plots efficient policy frontiers, both with and without the effective lower bound, so for both of the cases I just mentioned. The frontiers are derived by searching over the parameters of the policy rule and plotting the lowest achievable pairs of the unconditional variances of inflation and the output gap. So being closer to the origin is better in this chart. The solid lines show the case in which the ELB is not binding or is not a binding constraint. And in this case, the standard inflation targeting framework performs very well. So that says if the extended toolkit can effectively compensate for the effective lower bound, then additional history dependence coming from, say, average inflation targeting or price level targeting doesn't really help to improve performance over inflation targeting. The situation is different, though, if you have an occasionally binding ELB. That's the dashed lines in the chart. In this case, inflation targeting is always dominated by average inflation targeting, and it's sometimes dominated by price level targeting. The weaker performance of inflation targeting in this case reflects the fact that history dependence is more important when the ELB binds. As I said, more history-dependent frameworks automatically keep the policy rate lower for longer, generating stimulus at the ELB. So for the next exercise, we evaluate the frameworks using a simple loss function. So the loss function we use is shown on this slide. It includes squared deviations of inflation from target, squared deviations of the output gap, and the squared change in the nominal interest rate. The latter term just penalizing excessive interest rate volatility. In much of the bank's past work, we've assumed that the relative weight on the output gap is equal to 1. So the weight on inflation and the output gap were equal in the loss function. Now, one possible interpretation of a dual mandate is that the weight on the output gap is actually greater than 1. So here, on this next slide, we plot the loss values for each of the different frameworks against the relative weight on the output gap in the loss function. And what you can see is in the case where the ELB is not a constraint, again, inflation targeting performs best for a broad range of values of that weight on output in the loss function. So inflation targeting is once again ahead in the case where the ELB is not a constraint, but just by a nose. Turning to the case where the ELB does occasionally bind, in this case, average inflation targeting is on top for most values of the relative weight on the loss function. So what this tells us is that when you take account of the ELB, again, the history dependence is more important, and average inflation targeting comes out on top. Interestingly, something between inflation targeting and average inflation targeting likely would do well for fairly large values of the relative weight on the output gap. So overall, in terms of these results, it appears PLT is dominated by less history-dependent alternatives, and that's mainly because of the departures from rational expectations in Totem, the rule of thumb behavior and wage and price setting that has been estimated in Totem. The horse race between inflation targeting and average inflation targeting really depends on how effective the extended monetary policy toolkit is. We don't see any gains from moving from IT to AIT, say, if the extended toolkit can compensate for the ELB in the simulations. But in this situation, IT is only ahead by a nose. On the other hand, average inflation targeting has a somewhat larger lead over inflation targeting if the extended toolkit is ineffective. So AIT, average inflation targeting in this case, appears more robust to assumptions about the ELB and the extended toolkit. So let's now expand the horse race to take account of 3 new entrants that are distinguished by the fact that they place more explicit emphasis on stabilization of a real variable. These 3 new entrants are the unemployment inflation dual mandate, which incorporates both inflation and unemployment as part of the framework, nominal GDP level targeting, and nominal GDP growth targeting. Note a couple of different things. So one is that the relevant real variable is different for each of these, the unemployment rate in the case of the dual mandate, the level or growth rate of real GDP in the case of the NGDP variance. In none of these cases is it the output gap, which was the relevant real variable in the previous 3 cases. The other thing is that, again, the degree of history dependence varies quite a bit across these. We can plot these sort of a stylistic plot here that gives you a sense of the degree of history dependence and the degree of emphasis on stabilizing a real variable of each of these frameworks. So I think the thing that comes across is that most of the things we're looking at involve either a higher degree of history dependence or a higher degree of emphasis on stabilizing a real variable than standard inflation targeting. An exception here is nominal GDP growth because it involves, because the real variable that enters nominal GDP growth targeting is in growth rate space, it actually ends up being less history dependent, and we'll see how that matters in a minute. So in terms of the approach to running this expanded horse race, we can't quite do what we did for the previous 3 frameworks because they were similar enough that we could evaluate them all fairly using the same ad hoc loss function. We can't really do that in this case because there are some fundamental differences, such as different real variables, different nominal variables in these frameworks, and so you might inadvertently penalize frameworks if you use a single ad hoc loss function. So what we do is we characterize each framework by a regime-specific delegated loss function and a simple policy rule. The delegated loss function is used to choose the parameters of the rule. It's not used to evaluate the framework. Instead, the frameworks are evaluated using volatilities of several key variables. We don't explicitly weight those volatilities into a loss function. Instead, we look for frameworks that stabilize a broad range of variables. So the table here just shows you what those delegated loss functions and interest rate rules look like. So for example, in the case of the unemployment inflation dual mandate, the unemployment gap is in the loss specification and the rule. In the case of PLT, the price level is in the loss specification and the rule. So they're specific to the variable being targeted. So in terms of the results, starting with the case where the effective lower bound occasionally binds. So this chart plots the volatilities of some key variables. A few key takeaways. One is no framework strictly dominates across the board in terms of its ability to stabilize all of the variables. But it does seem that inflation targeting, average inflation targeting, and the dual mandate emerge as the most robust options in the sense that they do reasonably well on most variables. This suggests that an intermediate degree of history dependence strikes a good balance between the benefits of affecting expectations at the ELB and the costs of destabilizing implications coming from the presence of rule of thumb or non-rational behavior in the model. That said, the quantitative differences here are quite small. So relative to history, the differences across these frameworks don't look very large. So for example, the deviation of inflation fell from 3.1% in the 70s and 80s to 0.9% in the 1995-2016 period. If you look at the differences in the inflation standard deviations here, the first set of bars on the chart, they're nowhere near that sort of magnitude of change. And so we're talking about much smaller differences than we've observed historically. Now, one dimension on which you do see some interesting differences is if you look at the whole distribution of outcomes, it looks like PLT, price level targeting, does particularly well at reducing the likelihood of very low inflation outcomes. So this just reflects the fact, again, that price level targeting does well at the effective lower bound, as we discussed before. But it suggests that price level targeting could be an attractive option from the perspective of limiting downside risks. And then in the case without an ELB, the results, again, are very similar. Again, inflation targeting, average inflation targeting, and the dual mandate emerges the ones that look more robust. And again, there's no across-the-board winner, and the differences look negligible. So we also conducted a scenario analysis in order to get a sense of how the different frameworks perform in a particular scenario. So we basically ran through shocks that looked like the beginning of the 2008-2010 financial crisis and simulated the model under the different policy rules. The thing that really stands out from these charts is if you look at the lower left corner, you see the purple line, which is nominal GDP growth targeting. Nominal GDP growth targeting starts to tighten monetary policy much earlier than any of the other frameworks, and that leads it to have much worse performance than any of the other frameworks. Why does that happen? It happens because the real variable that enters nominal GDP growth targeting is the real GDP growth rate. But because it's a growth rate, the growth rate starts to rise as soon as the economy starts to recover, even while the level of output is really depressed. And so you start to tighten interest rates too early. The other thing that it's a little bit harder to see is that the more history-dependent policies do well at the lower bound. They tend to outperform, though the differences are smaller. So let me briefly talk about some of the alternatives, starting with heterogeneity and inequality. So we use a simple alternative model that allows for idiosyncratic income risk. In the model, inequality rises when the output gap is negative. This captures the idea that that inequality tends to rise in recessions. So again, here we can look at the volatilities generated for various variables in this model. As in totem, there's nothing that strictly dominates. We also have a couple of additional things from this model. One is we have a measure of consumption inequality here. And we see that the more history-dependent options, like PLT, tend to do worse on this consumption inequality measure. Now, this is measuring the cyclical variation of consumption inequality, so how much inequality changes over the course of the cycle. The reason we're looking at that is, number one, that's what enters the welfare, the model consistent welfare function. But two, in the model, monetary policy doesn't affect steady state inequality, but it does affect how much inequality varies over the course of the cycle. And you can see that the more history-dependent variants cause more variation over the cycle. So, and then let me just go to the next slide. So we also look at a simple ad hoc loss function where we just vary the weight on this, this measure of the cyclical variation of consumption inequality. And what we see here is that if you put enough weight on stabilizing the degree of inequality, inflation targeting turns out to be best. Why? Because inflation targeting does a good job of stabilizing the output gap relative to, say, price level targeting or average inflation targeting. So the more history-dependent variants tend to do better at stabilizing inflation, where the less history-dependent inflation targeting framework does a relatively better job of stabilizing the output gap also. And so the output gap, as I mentioned, is closely linked to inequality in this model, so that inflation targeting turns out to be desirable if you place a lot of emphasis on stabilizing the degree of inequality. Let me just skip over a couple of slides here, because I think we covered that. And I want to talk a little bit about the laboratory experiments that we're doing. So the idea with these experiments is to assess how real people would form expectations under different monetary policy frameworks. So this gives us insights into how well people understand the frameworks and whether expectations are likely to be stabilizing or not under the different frameworks. So in terms of the design of the experiment, the subjects in the experiment make inflation and output forecasts. The actual outcomes for inflation and output are then determined by plugging the median forecasts of the subjects into a simple New Keynesian model. And the subjects are paid real money based on their forecasting performance. The average payoff for a subject was about $25. So in the instructions, the subjects are given a lot of information to help them understand the experimental economy. So they're given information on the structure of the economy, they're given information on the monetary policy framework, and they're given it both qualitatively in words, but also in equation form. And so what we can do is we can try to use the data generated by the experiment to think about what sorts of expectations formation mechanism different agents use. So I won't get into each of these, but I think the bottom line that's important is that non-rational expectations, so mainly trend chasing, constant gain type expectations and naive expectations, are the most prevalent. And so for this reason, inflation targeting and the dual mandate tend to perform better than the more history-dependent alternatives. And this reflects the prevalence of these non-rational expectations, and it in particular reflects the fact that the history-dependent frameworks seem to induce extrapolative expectations, so trend chasing, which actually makes them destabilizing. So just to wrap up, so the analysis I presented today doesn't identify a clear winner of the horse race, but it does help us to identify some of the relevant trade-offs. So first of all, PLT performs well in terms of inflation stabilization, but this comes at the cost of greater output gap volatility and therefore greater cyclical volatility and inequality. The frameworks with the highest degree of history dependence, price level targeting and nominal GDP level targeting, do well for large negative shocks when the ELB binds, which is an important characteristic. On the other hand, nominal GDP growth targeting does not perform well in terms of macro stabilization at all. Overall, I think the frameworks that perform well on a number of margins are inflation targeting, average inflation targeting, and the unemployment inflation dual mandate. None of these dominate across the board, but they do appear to be fairly robust. Now, importantly, the interim results suggest that the differences in performance among these frameworks are relatively small by historical standards. Consequently, it's not yet clear if any of the alternatives would offer expected gains large enough to justify shifting away from the proven and successful inflation targeting framework. Now, the analysis I talked about today focused mainly on the macro performance of the alternative frameworks. As I said earlier, we have a lot of other work in train for which we'll have results in the coming months. I won't discuss what that work is in detail now, but I'll leave this slide up in case there are questions on that. So with that, I'll stop and we can turn to the Q&A session.
Thank you, Rhys. So we'll now start the Q&A session, and we have actually received several questions already through the chat. We will get to as many as we can. So the first question is from Giovanni Lombardo, who's at the BIS. And here he's basically thinking of the inflation targeting framework as giving an objective for inflation. So in that context, what is the source of history dependence, and isn't really just commitment to the rule? And in that context, again, isn't the current flexible inflation targeting, which is more like a Svensson-type flexible inflation targeting, not already dealing with the bygones problem?
Right. That's an interesting question. So I guess I would interpret that as a question about discretion versus commitment. So if the central bank is assigned a loss function that includes, say, inflation and the output gap, if it minimizes that loss function under commitment in the sense that that it can commit to it can commit itself in terms of its future actions, then yeah, you would get history dependence naturally coming out of that sort of setup. I think the issue is that sort of commitment is not time consistent, and so if instead you're optimizing under discretion, then you do end up with a rule that it doesn't have much history dependence if you've delegated the central bank an inflation targeting loss function. If you instead delegate the central bank, say, a loss function with a price level in it, then that would more closely mimic the outcomes in the case in which you have commitment. So I think I interpret that as sort of a case where, yes, in an ideal world, it would be feasible to just assign an inflation targeting loss function, and you'd get history-dependent outcomes coming out of that. In practice, I think we don't think that that's really the case. In fact, all inflation-targeting central banks tend to talk about their frameworks in a way that suggests that bygones are bygones, so that there isn't a whole lot of history dependence there.
So we have some other questions that are related to that idea of bygones are bygones. So the second question came from Angelo Molino, who's at University of Toronto. The bank's history with inflation targeting doesn't look like a bygones or bygones outcome. The path of CPI seems to follow the price level trend path very closely. Are you building in this feature of the data into the horse race when you're evaluating inflation targeting?
Yeah, so that's interesting, and I mean, I guess if you think about inflation targeting, the bygones or bygones means that the expected variance of inflation blows up as you look very far out into the future. But if the shocks are symmetric over time, then you will end up with a price level that maybe looks like it's staying sort of on average at 2%. Now, I take Angelo's point that if you look up until, let's say, 2010, it looked in Canada like the price level was fairly closely following what you'd have gotten under a price level target. Since then, inflation has, on average, undershot the target a little. So it's a little less true now than it was, say 10 years ago. In terms of what's built into the simulations and the data, so what we're doing is we're using the actual data to back out shocks from using the model with the actual data to back out shocks. And then we're taking the distribution of those shocks and plugging it back through the model with different policy frameworks. Now, when we back the shocks out, we back them out under a policy rule that involves inflation targeting. So it does allow for price level drift. So that assumption is sort of built in. But there is also a significant amount of interest rate smoothing built into that policy rule, which does undo some of that. So it has a fair amount of history dependence in the way we back out the shocks. So I would say that we're not assuming that the price level is trend stationary when we're setting up the problem, but we are allowing for some degree of history dependence.
So I'm now going to jump to a question from John Murray, who's a former deputy governor at the Banque of Canada. His question is, the rule of thumb behavior plays a critical role in the results. How confident are you in your estimates of how important it is for households and firms? How confident are you in the way it is assumed to operate and how it has been modeled? You seem to treat backward-looking expectations and rule of thumb behavior as the same thing. And is this correct?
Yeah. So I guess let me start with the last part. So I would say that the backward-looking expectations and the rule of thumb behavior are not exactly the same thing, because I would think of backward-looking expectations as affecting all the expectations in the economy. The rule of thumb behavior is actually affecting how price setting and wage setting decisions are made in particular, but is not necessarily affecting other sorts of decisions in the economy. So it's more limited in scope in that sense. In terms of confidence in the estimates, I mean, I think this is always always an issue. We don't. So there's not a whole lot of persistence in the inflation process. So actually, the rules of thumb that we estimate tend to put a lot of weight on the inflation target, as opposed to lagged inflation necessarily. So what that means is you can think of that in the real world analog would be people being aware of the bank's 2% target and then making, say, firms making price setting decisions based on that. It's hard to say whether or not how realistic that rule of thumb is. I don't think we have good evidence to support necessarily the particular specification of the rule of thumb. I think the rule of thumb, though, does play an important role in generating the inflation dynamics that we see in the data. So we took that away. We'd need something else to generate those sorts of inflation dynamics, and that something else would probably end up yielding similar results, similar implications in terms of the ranking of the frameworks.
So another question from Angelo Molino at the University of Toronto. The laboratory experiments don't allow for the possibility that individuals in the room have access to tools to improve their forecasts, so they can ask friends, family, or hear opinions of experts. Does this in any way impact the results?
Yeah, so that's an interesting question. So in fact, they're specifically instructed that they're not allowed to speak to one another during the experiment. They are allowed to ask questions, clarification questions, of the individual running the experiment. So there is an opportunity to try to understand the documentation that we've given them, and we do give them quite a bit of information about the artificial environment that they'll be in during the experiment. Would there be scope to sort of learn through interactions? More so, it's entirely possible, and I can't speak to whether or not that would the extent to which that might change the results.
It's now a question from Stéphane Lavoie at the Banque of Canada. Could the results suggest that a standard IT framework with a temporary switch to average inflation targeting or price level targeting only when the ELB binds be a possible win-win combination? Or would that be an incorrect interpretation of the analysis?
Yeah, so actually that's the last bullet, the last sub-bullet in that first set of bullets on this slide that I have up is referring to exactly that idea. So it's something that we have looked at a bit in the past. And in principle, it could be a very effective way of implementing policy. The issue, of course, is whether people will understand that, because you're sort of midstream switching what you're targeting and then switching back. And would that create confusion and communication issues that would undermine the effectiveness of that relative to what we see in the model simulations? And that's not something we've really pushed in the experimental setting, which would be interesting to get a sense of that.
So Rudy Narvis has asked the question, did you run simulations that included the possibility of the adoption of average inflation targeting by the U.S. Federal Reserve? And I'm going to actually add on to that question a little and just say more generally, did the simulations account for any potential changes in policy frameworks in other central banks?
Yeah. So a couple of things. So no, Sharon, the answer to your question is no, that the framework that the simulations assumed an inflation targeting framework in the United States. So in terms of, I think we need to talk about what average inflation targeting means, because I think the discussion in the context of the Federal Reserve's review has defined average inflation targeting somewhat differently than the way we've defined it and the way the broader literature has. So in our definition, average inflation targeting is targeting a multi-year average of inflation. So it's sort of lengthening the window for inflation from 12 months, which is the standard, to something longer, like say 3 years in the simulations that I showed you today. In the context of the discussion around the Federal Reserve's review, average inflation targeting has been what's been called fuzzy average inflation targeting. So the idea is that when you're at the effective lower bound, you tend to undershoot the target. And so when you're away from the lower bound, you tend to hit the target. But that means that on average, you'd end up undershooting the target. So the idea of average inflation targeting, as it's been discussed in the US, has been to sort of, when you're away from the target, aim for a little bit higher than 2%. So something in the, say, 2.25%, 2.5% range. And that would mean that would offset the periods when you're constrained at the lower bound, and sort of you'd end up with 2% on average. There's an important difference with respect to what we talked about today, and that is that the way it's been discussed in the US, it's not really as history dependent, because there isn't a commitment to accumulate the misses and make up for them subsequently. It's more opportunistic. It's that when there's an opportunity, when the ELB is not binding, we run inflation a little bit above. So it's a bit different, and in that sense, I actually think it makes it a little bit less important that we didn't contemplate the changes, because what that fuzzy average inflation targeting ends up looking like is more like a change in the level of the inflation target. It's like raising the inflation target effectively from the 1.7 that it would have averaged to, say, 2%. Now, that does have implications, but those implications would tend to be, at least in our setup, limited to the rate of change of the nominal exchange rate. And so that the flexible exchange rate means that we would be able to still pursue a different framework without too much of a broader issue.
So the next question is coming from Bill Robson, C.D. Howe Institute. Price level targeting might be a framework in which the numerical target is uniquely important. A commitment to ensure that the purchasing power of a dollar stays the same over time is qualitatively different from a commitment to ensure that purchasing power of a dollar erodes at some constant rate. Might that make the impact of price level targeting on expectations and behavior different if the target were a constant price level rather than a rising one?
Yeah, I mean, that's a very interesting question. It's not something we can get at in the models per se, because of course people in the models either understand or are following simple rules. I think if we think about more generally, I think what would really be different that we didn't talk about today is that price level targeting means you have some long run price level certainty, so that in forming longer term contracts, in thinking about longer term decisions, there may be effects that operate through that channel. And our past work we had done, say, for the 2011 renewal, did get at some of these things. And as I said, I wasn't able to get into the sort of the whole literature on these frameworks today, but I think there are important benefits that we know accrue from that longer term price level stability that I think are getting at sort of what Bill was suggesting.
So a question from Ricardo Reese at the LSE. Your horse race assumes that once you change regime, agents believe it right away and think you will never change regime again. Have you, 1, considered transition dynamics across regimes, especially if we don't have rational expectations? Or 2, tried giving the status quo of inflation targeting a leg up by noting that any change would increase the perceived probability and thus uncertainty of further regime changes in the future?
Could you repeat the last part?
So the second one is tried giving the status quo, so current policy of inflation targeting, a bit of an advantage by noting that any change from that would increase the perceived probability of a future regime change.
Right. So I guess it would depend on how those future regime changes happen, if they're random or if they're responding to conditions in a way that makes them beneficial. But I think, so a couple things stand out to me. One is that if you were to contemplate, say, a change from inflation targeting to something more history dependent, like average inflation targeting or price level targeting, if expectations didn't adjust, and so I should say we haven't taken account of any transition dynamics, but if you didn't get an immediate adjustment of expectations and a recognition of how this new framework worked, you would get more volatility. How much more is a quantitative question that I don't have the answer to, but it certainly would undermine the performance, at least for a period of time, of the new framework. And given that the margins that we're talking about are not that great in terms of the differences in volatilities across these frameworks, those sorts of transition dynamics could really undermine the case for change, but it's not something we've quantified.
So I'm going to actually end it there. I'll give one quick comment on Ricardo's last question, which was there was some analysis done by the bank in advance of our 2016 renewal, where we looked at exactly that question of if people need to learn about a change in regime, in that case it was to a higher inflation target, how costly would that be? So that may be an interesting piece of analysis for Ricardo to look back on. The answer was actually quite costly in that exercise. So thank you once again to our presenter, Reese Mendez from the Bank of Canada, and to all of those who have submitted questions. We'll now take a short break and resume at 11:20 Eastern Time.
My name is Anthony Landry. I am a senior research advisor at the Bank of Canada, and I will be moderating the continuation of this first session titled Comparing Monetary Policy Frameworks, an update and discussion of the horse race. Joining us for the second part of this session are Dr. Joseph Gagnon from the Peterson Institute of International Economics, Professeur Pierre Fortin de l'Université du Québec à Montréal, and Professor Stéphanie Schmidt-Grohe from Columbia University. Dr. Gagnon is a senior fellow at the Peterson Institute for International Economics. Before joining the Peterson Institute, Dr. Gagnon held increasingly senior roles at the Federal Reserve Board in Washington and at the U.S. Treasury. He's a well-known expert in monetary policy framework and international trade and finance. Pierre Fortin est professeur émérite à l'Université du Québec à Montréal. Un nom bien connu du public québécois et canadien, professeur Fortin a publié dans de grandes revues académiques et pour monsieur tout le monde, dont mes parents. Il apparaît aussi fréquemment dans les médias nationaux pour discuter d'économie. A household name in Quebec and Canada, Professor Fortin has published in leading academic journals and for the public at large, and often appears in national media commenting on economic issues. Finally, Stéphanie Schmidt-Grohe is a professor of economics at Columbia University and a research associate at the National Bureau of Economic Research and at the Center for Economic and Policy Research. Her research focuses on the design of monetary policy and on understanding the source and propagation of macroeconomic shocks. So we have allotted 20 minutes for each discussion, followed by 15 minutes for questions. Once again, we encourage questions from the audience during the presentation. And to do so, please send your question using the chat function on the right-hand side of your screen at any time during the presentation. Please remember when sending your question to direct it to all panelists in the drop-down panel. And my colleagues are adding these instructions in the chat box now. Question will be compiled and asked after all three discussants have presented. So now I would like to open a discussion with Joe Gagnon from the Peterson Institute. To remind you, you have 20 minutes, and I will give you a polite 5-minute reminder 5 minutes before the end of the 20 minutes. All right. Joe?
Okay, thank you for inviting me to this conference today. I actually am kind of missing a first slide, which would recap quickly what about the paper. This paper on the horse races presents results for Canada that are very similar to results for the United States, recently done by some former colleagues of mine, Ben Bernanke, Michael Kiley, and John Roberts is one paper, and then David Reichschneider, David Wilcox is another paper. And they both find very similar results in terms of the pros and cons, costs and benefits of different policy rules, and also how those rules react to the effective lower bound. So I actually find the paper's results totally plausible, given the model, the type of model and assumptions in the paper. But I want to go on to something I think is more fundamental concern about the assumptions behind these models that I think is appropriate. So, Kevin, next slide, please. To varying degrees, I would argue that countries around the world have fallen into low inflation traps since the 1990s. In these traps, growth is satisfactory, close to its potential rate on average, but I believe the level of output is persistently below potential, and we've mismeasured potential. What we see, a common observation, is that fairly large changes in unemployment rates have little effect on inflation, which remains low. And coincidentally, in this week's Economist magazine, there's a good focused piece on precisely this last point, sort of the flatness of the Phillips curve, which I believe can easily be explained. So next slide. If you consider that the Phillips curve is nonlinear, and it always was. Back in 1958, A.W. Phillips showed in a low inflation gold standard environment, at least with low expected long-run inflation, that low unemployment rates had very little effect on wages. Low unemployment rates had raised wages a lot, but high unemployment rates had very little effect. They reduced wages only a little. And the reason I believe is that low trend inflation bends the Phillips curve because downward wage and I believe price rigidity too, but I'm focusing on wages here, truncates the distribution of individual wage changes. But when inflation is about 5% or more, you don't see this. The curve is linear as we normally think. Okay, next slide, please. So here's a figure from a paper I wrote with a former colleague, Chris Collins, last year. And it's a theory model of exactly what I just said. It's a model of individual wage bargaining with a distribution of productivity shocks across workers that averages to zero. So I'm abstracting from productivity growth. So therefore, wage inflation is inflation. And people bargain for wages based on what they expect inflation to be, and that's different possible values of expected inflation are listed. So the top line, where expected inflation is high at 10%, you see the Phillips curve is quite linear, and actual inflation comes out at the expected value of 10% inflation when unemployment gap is zero. So you're at potential output. And of course, the equilibrium is when the actual outcome is what was expected. Now, as you go to lower and lower inflation rates, two things happen. First, the gap rises. So if you look at the next line down where expected inflation is 5, what you see is that the unemployment gap needed to get you to the equilibrium of 5% inflation is actually above zero. It's about 1 in that case. And as you go to lower and lower inflation rates, that permanent effect on the unemployment gap increases. The other thing that happens is that the right side of these curves get flatter and flatter. So that means that large changes in unemployment don't really do much to inflation. Now, this is a theory model with just made up parameters, so don't take these particular numbers seriously. I think this chart may overstate the effect on the equilibrium gap. The fact that lower inflation raises the gap, I think that's true, but maybe a little overstated here. On the other hand, I think this chart understates the flatness, as you'll see later. I think actual Phillips curves are even flatter on the right side than this would show. Okay, so next slide, please. So I think Japan, the Euro area, and frankly Canada, I believe, have been mostly in the flat region of the Phillips curve for decades, and that's why if you plot the data, you don't see a Phillips curve. It's hard to estimate one. Estimated slopes are very low and not significantly different from zero. You've been in a region in which you've been near your target for inflation. Output growth's been around potential, but the average level of potential has been lower than potential. Average level of output has been lower than potential on average because potential is underestimated. It's hard to estimate potential in this world. We tend to think potential is the place where inflation is constant, But if inflation can be constant at very different levels of output, you're going to overestimate the unemployment gap. You're going to underestimate potential. And interestingly, John Maynard Keynes, in the General Theory back in 1936, said this was the way the world almost always was in the ultra-low inflation gold standard. Next slide, please. So, in turning to the paper, none of the policy rules in the horse race paper actually can avoid this low inflation trap. This is a major problem in my view. As I say, low inflation pushes the equilibrium output below potential, an unemployment rate above the NAIRU. And then neither inflation nor the price level in these rules is providing much information on where equilibrium output is. This is the flat Phillips curve. And if you aren't getting much information from the inflation rate and your measure of the output gap is mistaken, then your rule really is without a good anchor. And of course, linear models of the Phillips curve are going to get you a downward biased estimate of potential output and upward biased estimate of the natural rate. Next slide, please. So what to do? Well, I think one thing is that we need to raise the inflation target further above zero to minimize the harm that's caused by these downward nominal rigidities. Then also, we need to use a correct nonlinear Phillips curve when we're estimating potential output so we don't get fooled. Alternatively, we need to be more agnostic about the Phillips curve and just aggressively search for what is the maximum sustainable level of output. And I think that this is actually something the United States has done. So next slide, please. The United States, I would argue, has sort of broken out of the low inflation trap on two occasions. One is in the late 1990s, and the other is in just the past few years, almost. Obviously, the COVID crisis has cut this experiment short, and I'm not going to have anything to say today about the COVID crisis. Everything I say ends in December 2019. But the Fed sought to test how low unemployment could go without sparking inflation. So you think of this as a dual mandate with an aggressive trial and error to find out where that maximum employment level is. And in doing so, the United States has actually generated more complete data on the Phillips curve than most other countries. You can actually see the Phillips curve in U.S. data. First, though, I'm going to talk about the unemployment experience. So next slide. Here we have 60 years of unemployment data in Canada and the United States. The red line is Canada. The dashed blue line is the United States. For the United States, I'm less of an expert on Canada, but for the United States, I would argue that the natural rate of unemployment was 4% back in the 50s. Then it rose steadily in the 60s and 70s as the baby boomers flooded into the labor market. It peaked in the early 80s at somewhere around 6 to 7%. When the median age of the workforce reached its low point at that point. Since the early 80s, the median age of the workforce has been rising steadily, and I believe the NAIRU has been falling steadily. And we are currently, or as of last year, the natural rate was just about 4% in my view. What you see in Canada is that in the 60s and 70s, the unemployment rates were comparable to the U.S., then a gap opened up in the 80s and 90s. Basically, Canada let inflation get out of control more than the U.S. It took longer to bring it under control. That was a bad period for changing macro outcomes. Since, however, the end of the 90s, you might argue that Canada's had better macro outcomes because it's stabilized the unemployment rate more than the U.S. And that's a sort of second moment advantage that Canada has. But I think that Canada may have missed out on some first moment gains. In other words, I think Canada could have pushed the unemployment rate even lower than it did. Maybe there's reasons the natural rate's higher in Canada, but they didn't used to be long ago, and it's hard for me to believe it would be more than a percentage point higher. What we see at the low points in the past 20 years is it's been 2 or more percentage points higher than the U.S., which I think is just a lost opportunity. And Jay Powell has been saying this a lot in the past year. He's going to say it again tomorrow. He's very proud of the U.S. pushing this unemployment rate down, the Fed pushing the unemployment rate down to test how low it can go, especially for low-wage and minority workers. This has been was a huge boon until COVID struck. Basically, when you had unemployment for white workers at 3%, a lot of employers turned and offered jobs to minorities that wouldn't have given them jobs, and their unemployment rate started falling even more than other workers. I think it was a huge a boon that the Fed has noticed and has paid attention to. And Chairman Powell has said that he thinks the Fed was wrong in its estimate of the natural rate of output of unemployment up until this point, and I agree. Next slide, please. So because we pushed to the natural rate and beyond a couple times, we've generated more data on the left side of the Phillips curve, and so you can actually see it. If you do this for Canada, you get more of a cloud in the right side of the curve, but in the U.S. you have both sides of the curve. You can see it's highly nonlinear. This looks very much like the curve that Phillips estimated back in 1958. Now, I know some people will say, well, this isn't a structural equation. This is just the outcome of demand and supply fluctuations. But I would argue that in the past 20-some years in the U.S., the supply shocks have been very small because expected inflation has been very stable. We've controlled for some demographic changes in labor force by using married male unemployment. And there really have been no significant changes to the U.S. labor market regulations or employment insurance systems. So for all those reasons, those supply shocks are very small. And demand shocks were big, and they traced out the supply curve of the economy. Next slide, please. So what are the benefits of higher inflation? Well, as I said, higher inflation will raise the equilibrium output towards its potential. It will also enable standard policy rules to work better, because when output is below potential, this will cause inflation to fall below target, and this will automatically make policy more stabilizing. And it's also making the Phillips curve more linear, so it conforms more to the kind of models we use in the horse race. Next slide, please. And an important benefit of higher inflation, of course, that's got a lot of attention now, is it relaxes the constraint of the effective lower bound ELB on interest rates. And this constraint is relaxed for both short-term and long-term interest rates, thus freeing up the scope for more quantitative easing or the extended monetary toolkit, as you said. I think an important point that I think needs mentioning I've written about recently, no amount of quantitative easing can push the long-term interest rate below the ELB or the policy rate. And that is to say that there's a bound on interest rates across the maturity spectrum. Now, when you have a higher inflation target, higher inflation rate, you obviously have more room to cut the short-term interest rate. And when you hit the ELB and the short rate in a recession, the long rate will come down a bit. But if you start with more inflation, it will end up above where it is otherwise, and it will give you more room to use QE to lower the long-term rate and lower the real long-term rate even more. And that is understated in all the studies I've seen. People don't get that part of the benefit. So they understate the benefits. Also, I would note, by the way, that this bound on the long-term rate is a good way to quantify the extent to which extended toolkit can actually work. Reese mentioned that there was some uncertainty about how much the extended toolkit could eliminate the ELB. Well, this is how much. It can push the long-term rate to zero and no further. Next slide, please. So I would argue that the loss function in the horse race paper understates the cost of the ELB. It's a symmetric loss function, so when you're above or below potential output, it's equally costly if you have 2 years above and then 2 years below, there's a certain cost. And it's the same cost if you were just below for 4 years. And I think that's just wrong. Extended periods of below potential are far more costly to everyone than swings around potential. And this is important because ELB episodes precisely generate these extended periods below potential, and those are much more costly than swings around potential. Next slide, please.
So just to let you know that you have five minutes left.
Perfect. I've got 5 slides left. Policy, as the paper says, policy rules with memory, or as the paper says, history dependence, do perform better against ELB episodes. And some people have argued that's all we need. Just go to a level nominal GDP or a price level target, and you can really get away from this ELB problem. But as this paper shows, even those rules are hampered at least a bit by the effective lower bound. And moreover, to the extent that they are better than the other rules, that benefit comes from extreme assumptions about expectations that may not be true, as was noted in the Banque du Canada's 2011 policy review. Next slide, please. So now the question is, well, how much inflation is needed? We don't like inflation, and moving to a higher inflation target is costly, as people say. And the work I've seen before typically talks about 4% inflation. And if you read between the lines, think about the real rate and the ELB, you might even argue for 5% inflation, and maybe that's a scary number. I would argue that you probably don't need to go that far. If you take into consideration the extended toolkit and how the inflation target affects that, a target of as low as 3% might suffice. As I say, higher inflation benefits both at the short end and the long end of the curve, which has been ignored in the literature. And also my colleagues, Dave Reicheneder and Dave Wilkins, have ideas for aggressive forward guidance that can also help. And so maybe some combination of only a small increase in inflation will be enough with more aggressive policies. Then finally, 2 quick points. Next slide, please. On the horse race paper, as Reese said, it assumes that the real equilibrium interest rate is 0.75%. I actually think it's 0%. And I think that, and there's other papers that talk about this, I think that central banks that have inappropriately used too high of a level have inadvertently pushed their economies into undershooting their target because of this. Now, obviously, the lower the equilibrium real rates, the more the ELB harms the economy, the more serious that constraint is. However, there's an offsetting error, in my view, in the paper, or assumption in the paper that offsets that. And that is that the paper assumes that the effective lower bound is above 0.25%. But we've seen we can have negative policy interest rates in other countries. And I believe that as low as minus 0.5% is not only possible, but not harmful and helpful. I don't think that this sort of reversal rate thing really kicks in until quite a bit below that. So I think that there is more room on the ELB, which means that maybe the frequency of the ELB generated by the paper has offsetting errors, and overall it's probably okay. But again, I think the loss functions I don't like. Final slide, please. Or next slide. This is the final slide with information on it. There's a small point in the paper about in these long-run target frameworks, one targets price level, one targets income, nominal income, which is a better target. Well, I actually have a different view in the paper. I tend to think that nominal income is a better target. First of all, I think nominal income is what monetary policy directly affects nominal spending. It only later flows into inflation and prices. So it's better to target something you affect. But in the long run, in particular, I think the way to think about this is, as we said, is for investors, debtors, and creditors. Well, if you're borrowing a long-term nominal debt, what you care about is your long-term nominal income. That's what you pay out of how you service the debt. So I think that's clearly better for debtors. For creditors, you might argue, well, income price level is more important because you want to know what is the consumption you can get from your level of saving. But I think it's possible that actually what savers think of is relative consumption. They want to keep their consumption relative to the rest of the economy with workers in retirement. And in that case, I think income is a better variable to target in nominal terms. And thank you. That concludes my presentation.
Thank you, Joe. Notre prochain discutant est Pierre Fortin, professeur émérite à l'Université du Québec à Montréal. To remind you, we have allotted 20 minutes for your presentation, and we'll give you a polite 5-minute reminder. Thanks. Pierre?
Okay. I'm going to read my notes to contain time and my language. There has been no change in Canada's monetary policy framework since 1993, despite the 5 periodic reviews, which suggest it has been, by and large, been successful. I don't know if this time will be different, but at any rate, I welcome today's exchange as an attempt on the part of the bank to engage stakeholders. I'm a stakeholder, happy to be engaged, and thankful to Senior Deputy Governor Wilkins for her kind invitation. Here are my thoughts. First on current events, and second on the horse race itself. We are currently struggling out of a deep recession and into recovery. As you can see, past recessions were short and followed by long recoveries. The cumulated macroeconomic costs were large, such as 15% of a year's GDP for the last one between 2008 and 2014. This time, the first few steps of the recovery are rapid due to the extraordinary set of collaborative action taken by Ottawa, the provinces, and the bank, and also because of a much larger number of layoffs than usual were recall-ready. But full recuperation will now probably take a number of years. Fortunately, all available signals are that the bank is intent on making a solid contribution to the recovery. The policy interest rate was lowered from 1.75% in February to 0.25% in March. And earlier this month, the governor assured markets that the rate will be held very low for a long time. The bank has deftly played its role of lender of last resort through financial markets, and it has actively involved itself in a large asset purchase program that has probably added to the decline of interest rates further across the yield curve, although by how much, of course, is uncertain. The yield on Government of Canada 5 to 10-year bonds is currently 0.5%, down from 1.2 back in February. The problem, as we all know, is that the room for monetary stimulus has shrunk in the past decade. Coming out of the last 4 recessions, the previous recoveries benefited from reductions of 9 percentage points in the policy rate on average. However, this time the downward adjustment has been a mere 1.5 points, or 6 times less. The drop in the average yield on Government of Canada medium to long-term bonds in February has also been smaller than in previous recoveries, despite the diligent asset purchase program. Presently, both short and long-term rates are at very low levels. The room for further conventional monetary stimulus is being limited by the narrow space remaining between the neutral policy rate, thought to be about 2.5%, and the effective lower bound set at 0.25%. In fact, in the past 13 years, the policy rate has been 1% or less for 75% of the time. It has never exceeded 1.75%. What it will be in the future is uncertain, but I have not seen research on the saving investment equilibrium in Canada or elsewhere predicting that it will come back up soon anytime. Market seems to agree. Interest rates will likely stay low, and the policy rate will be at or close to the effective lower bound for an extended period. One means of getting greater monetary stimulus would be to increase the inflation target by a couple of percentage points, say to 4%. This would make room for larger reductions in the real interest rate when needed. Many economists have made this suggestion in recent past. The higher inflation rate would generate more modest additional economic costs, but they would be exceeded by the huge benefits from enabling the central bank to better fight recessions and support recoveries. In the 1980s, Canada's inflation rate averaged a very stable 4.4% without showing any sign of slipping to a higher level. However, even putting aside the difficulty of going from 1 to 4%, witnessed the Japanese experience of the last 25 years, there is an insuperable problem with raising the inflation target from 2 to 4%, in that it would almost certainly be a political non-starter. As Ben Bernanke recently claimed, it's just not going to happen. How much further stimulation does the Canadian economy need now? According to the central scenario of the July monetary policy report of the bank, it can be inferred that output would be short of potential by about 6.5%, or some $150 billion in 2021. In the short term, fiscal policy is the only instrument at our disposal that can make up for the lower bound on the interest rate and bring the economy to fuller recovery within a couple of years. Assuming that the multiplier effect of government expenditures is 1.25 and the marginal tax-less transfer marginal rate is 40% nationally, an addition of $60 billion to public spending in 2021 on long-term could in principle close the gap. The current interest rates of 1% or less on long-term Government of Canada bonds would facilitate the financing of federal deficits, of course, but there could be a political restraining effect on borrowing after the very large deficits incurred in 2020. Coordination with provinces would be essential because 2/3 of current spending and 85% of capital spending in Canada's general government sector is provincial or local, but it would not be easy. One would also have to get over the classic difficulty of deciding what kind of welfare improving spending should be increased and how much could be done on short notice by the 14 government authorities. All said, further fiscal stimulus is not a sure thing going forward. Full recovery could linger. Turning now to the medium and long term, what bank staff have done so far is to compare and contrast various monetary policy frameworks that might allow us to escape from the cage. The frameworks include the current inflation targeting scheme and all the 5 other frameworks that have been described by RIS. The window is 1 year for inflation targeting, 2 to 3 years for average inflation targeting, and eternity for price level targeting. The impacts of the frameworks on inflation and output volatility are simulated mainly with the help of the various versions of the Bank of Canada's terms of trade economic model, which they call TOTEM. TOTEM is a large-scale open economy dynamic stochastic general equilibrium model of the Canadian economy. Its structure details firms and household demand, wage price adjustment, and the monetary policy role. This kind of model relies on assumptions that are, of course, criticizable, but TOTEM does at least attenuate some of the extreme hypotheses, such as full system-based expectations, and it can impose the occasionally effective lower bound of 0.25% on the policy interest rate. The monetary policy frameworks are compared by looking at variances over time of key variables such as CPI inflation, the output gap, unemployment, and GDP growth. Staff reports 2 sets of simulations. The first set compares the 3 consumer price-based frameworks, IT, AIT, and PLT. The most relevant environment is one, in my view, in which a fraction of households and firms are rule of thumb wage and price setters, The 0.25% effective lower bound is occasionally binding, and unconventional monetary tools are ineffective. The optimality of history dependence here increases with the binding importance of ELB, as explained by risk, but decreases with departures from full system-based expectations. In general, Totem finds that PLT is dominated by IT and AIT, and that by and large, AIT holds some lead over IT. When the effective lower bound does bind, then a modest amount of history dependence under AIT can be beneficial, even if rule of thumb expectations are present. This is all okay. I'm just worried that DSGE-based exercises as this one are concerned not about maximizing the level of output over time, but only about minimizing its variance around some filter-generated average trajectory that is then interpreted as being potential output. The question is what the results would look like if, say, Blanchard-Summers hysteresis, Nakamura-Steinson plucking, or Akerlof-Dickens Phillips curve convexity were to be taken seriously and explicitly into account. Riss has mentioned earlier that they're going to take up some of those aspects in later experiments. The second set of simulations with Totem extend the list of frameworks compared to include the dual mandate and nominal GDP level and growth, which emphasize impacts on the unemployment rate and nominal GDP. In the same constrained environment as in the first set of simulations, with rule of thumb price setters occasionally binding ELB and ineffective UMT, the calculated unconditional standard deviations this time suggest that IT, AIT, and the dual mandate would be the most robust of all the frameworks, all 6 frameworks, roughly in terms of how well we can stabilize the variances of a set of 6 separate variables of interest. The fact that PLT and NGDP, nominal GDP level and growth targeting frameworks are found to be somewhat or decisively inferior comes to me as a relief. The long history dependence carried by BLT simply does not make practical sense. The 2 nominal GDP frameworks in particular pose insurmountable practical problems. CPI inflation is easily understood by the general public. Its components have direct meaning for household welfare. CPI data are timely and they are not revised over time. But in contrast, there would be confusion about the split of nominal GDP between the price level and real GDP, as well as frustration arising from the frequent and often persistent divergence of export prices in GDP data and import prices in CPI data. This difficulty would be compounded because we are a very open economy. 1/3 of GDP is trade. This difficulty would be compounded by the lags in getting the GDP data and by the frequent and large exposed revisions. It would also be quite a challenge for the Banque of Canada to explain to Eastern and Central Canadians that interest rates need to be raised due to an increase in the price of oil that would be boosting incomes in Alberta, Saskatchewan, and Newfoundland. Eastern and Central Canada would have to suffer then both from the Dutch disease and the GDP targeting disease simultaneously. From their simulation with Totem and complementary models that Riss has explained, the authors conclude that the alternative framework do not seem to offer expected gains large enough to justify shifting away from the proven and successful inflation targeting framework. I basically agree. The 2021 agreement should keep the current flexible inflation targeting framework operated independently by the central banks. Operational independence would remain with the 2% CPI target and the 1 to 3% control range around it unchanged. But the simulation results seem to me to suggest that a somewhat more flexible approach would be welfare improving. First, a temporary shift to AIT in bad times would be advantageous when the policy rate needs to be kept at the ALB, the effective lower bound, for a while. And second, putting more emphasis on unemployment depending upon circumstances would also be helpful. On the macroeconomy game more generally, it is desirable that the 2021 agreement begin to clarify in simple terms what the two objectives of low inflation and maximum employment actually mean for government and the Bank of Canada and will require from then on. I see four reasons for this. One, if the steady state Phillips curve is flat at low levels of inflation, as I've shown myself in past research and Joseph has emphasized in the previous presentation, equilibrium unemployment is not independent from inflation, even in the long run. Second, coming out of a recession with tax dependence lurking, unemployment may be dangerously slow to return to equilibrium. Third, with the squeeze on monetary policy and the smaller cost of debt service, there is a need to conform more affirmatively to the Tinbergenian prescription of close coordination between the two instruments of fiscal and monetary policy in order to achieve the two goals of low inflation and maximum employment. And fourth, lastly, Canadians have, I think, a basic right to comprehend this general 2x2 macro policy game if they are to make informed judgments about it. Thank you very much.
Merci, Professor Fortin. We will now turn the floor over to our third discussant, Stéphanie Schmidt-Grohe, Professor of Economics at Columbia University. To remind you, we have another 20 minutes for your presentation, and I will give you a polite reminder when you have 5 minutes left. Stéphanie?
Hi. Just to be sure, make me a presenter so I can share. All right. Thank you. All right. Good morning. Thank you very much for giving me the opportunity to comment on this review of the monetary policy framework. So let me give you a brief summary of exactly what is done in the working paper that I got and that Reese presented, very comprehensively earlier this morning. The paper considers 4 models of the monetary transmission mechanism. The main top-down model, which is an open economy model, and it is with and without the zero lower bound, which is called the effective lower bound. A Henk model, in which the interest is whether the real interest rate affects economic outcomes, not just through consumption savings choice, but also through affecting budget sets of households, and it's a little bit different transmission mechanism. And then there's a fourth model, which is bounded rationality. Just that we know what the scope of the analysis is, I want to briefly be clear about what is actually done here. So throughout the analysis, it is assumed that the instrument of the central bank is the nominal interest rate, and that this nominal interest rate is set in all cases as an interest rate feedback rule. And what the paper does, it considers, if you want to, 6 different versions of the interest rate feedback rule. And I listed them here. They are meant to capture the status quo, which is inflation targeting, and these history-dependent rules, average inflation targeting, price level targeting, nominal GDP targeting, nominal GDP growth targeting, and dual mandate. And then the paper has a certain algorithm to find the coefficients of these rules. And once this is done, the coefficients are found. What the paper does, it computes second moments. That is to say, it computes variances, standard deviations of key macroeconomic variables. And then you could think of what the sort of mechanically the paper does is really telling you how we obtain a mapping of different interest rate feedback rules to standard deviations of macroeconomic variables of interest, right? And so then, yeah, on my comments about how this speaks to alternative monetary policy frameworks. So it is my impression that what is done by construction is a framework in which the objective is standard deviations. Why? Because it is my impression, and correct me, Reese, if I'm wrong, that means of variables here are always equal to the non-stochastic steady state, and so none of these 6 different interest rate feedback rules do affect means or levels of variables. So it's maybe just a semantic comment, but in my view, when I started reading and I saw the word alternative monetary policy frameworks, I was thinking, or maybe I was expecting some frameworks that would be able to say something above and beyond standard deviations of particular key macroeconomic aggregates, and maybe talk about needs. So that's what are my comments. So is this really a horse race of alternatives to the 2% inflation target? And I don't think it's about alternatives to a 2% inflation target, because as I mentioned, my impression is that for all 6 interest rate feedback rules considered, if you were to ask agents in that economy what's the long-run expected inflation rate, it is in all 6 cases 2%. So they are not really alternatives to a 2% inflation target. Moreover, since these seem to be linear models, the population mean, that is to say the unconditional expectation of inflation, it appears to me from the way it is executed is also always equal to 2% inflation. So therefore the way the horse race is set up or the tracks are laid is really a comparison across standard deviations of individual variables, and then I guess there's an intuitive link about is lower standard deviations in the output gap and maybe lower standard deviations in employment and lower standard deviations in the long interest rate. Maybe intuitively we can relate that to higher welfare. So there's probably a good reason for why the researchers went this particular way. It is, if you want to have a model like Totem or other models that are empirically realistic, going to models in which means change is probably difficult. But one comment about this way of proceeding would be, given that the 2 challenges that we're given, namely to talk about what does it mean that the natural rate of interest is lower, and what does it mean that perhaps there is now a concern about our indebtedness. In principle, staying within the mode of analysis chosen by these authors, one could have at least considered how do standard deviations change if we do change the long-run natural rate. And so that is to say, do these standard deviations, are they at all sensitive to this steady state parameter, which is the real interest rate? Okay. So why? My second comment is, are we looking for monetary stabilization policies, or when we say we want to consider alternative monetary policy frameworks, are we interested in maybe considering policies that are able to change means rather than just standard deviations? For example, I think as some of the earlier discussions mentioned, given the recent history of the zero lower bound, it seems that there are some occasionally binding constraints, and maybe the reason why there's an interest in history-dependent monetary policy specification, or more history-dependent monetary policy specifications, is to try to affect the mean of output or to lower the mean of the unemployment rate. And why are we looking at these history-dependent rules? Just to give the basic intuition again, if the economy experiences a negative shock and inflation output is low, the policymaker tries to undo some of the inefficient distortions that the economy has that often is manifested in price and wage rigidity. And so the policymaker is trying to get the real interest rate down to the efficient real interest rate. So since the real interest rate is the normal interest rate minus expected inflation, one way of doing this is to lower the normal interest rate. But there's a bound, which is this effective lower bound that the framework of the report actually takes into account. And another way is to play around with expected inflation. And these history-dependent rules, what they basically do is they tell you, oh, if we are in a recession right now and we have missed the inflation target in the past, let's design monetary policy in such a way that inflation will overshoot a little bit in the future. So expected inflation is higher than normal. Why is that desirable intuitively? Because it also lowers the real interest rate and thus stimulates domestic demand, as this is not a good moment to save. This is a better moment to spend. And also, say, in models with somewhat normal wage rigidity, what this would give you, if there's higher inflation, it would give you that real wages fall more and you have more income. And if people have more income, they can consume more. So that's the basic motivation for considering these history-dependent rules. And I think many of the people who are advocating them, not all of them, but some of the people are thinking that these are really policies to change the mean. And my comment was, given the sophistication displayed by the team of the Bank of Canada, how many models they were able to handle, I think seems to me a step that they could do, that they could think about how do means change in these alternative monetary policy frameworks. For example, the report didn't talk about this, but my impression is that in the case when you say we do consider the effective lower bound, your different interest rate feedback rules should say something about the mean. Do these 6 interest rate feedback rules give you a different mean? That would be something interesting to consider. Then it seems to me that you do have the sophistication there, given what is shown, to also consider other occasionally binding constraints besides the zero lower bound. For example, downward normal wage rigidity, as also Pierre Fontaine already mentioned. We know from work like I have done with Martin Uribe that in those type of models, we know this also since Tobin, I want to go back to Keynes, in those type of models, we know that monetary policy does have an effect on the mean. It has an effect on mean unemployment. And in those models, it is desirable to have inflation sometimes going up as a way to lower the real wage to full employment wage. So this is something that maybe the team at the Bank of Canada could use to look at monetary policy not having a second-order effect by looking at variances, but having a first-order effect. The third way of doing this, given the official challenge of this review, is to think about effects on high private sector debt levels. And somehow there must be, I guess, a notion, if this is a concern, that this is something bad to have these high private sector debt levels is to think about models with some collateral constraints or financial frictions in which the economy, without an interference from the government, somehow takes on too much debt, and there's in the formal language, that is to say, there's a pecuniary externality, and if the government could intervene, it might bring about a level of debt that is lower, and therefore it has a level effect on welfare. So I think that might be one way in which the team that seems, they are able to handle very sophisticated models might move their analysis. A more concrete comment, if the answer is, yes, we of course know that just looking at standard deviations is not ideal. Standard deviations are not welfare. Standard deviations, monetary policy has maybe levels effect. We can't handle this. At least, I think one of the things that will be interesting to do is, within the analysis they have, is to say, we would like to visualize a little bit what's the difference between these 6 alternative interest rate feedback rules. We know the status quo is inflation targeting. And so what they could do is they could use the totem, and then they could extract the historical error or shocks that were hitting the Canadian economy. So we have a time series for those. And now we can feed them into the same model with the alternative interest rate feedback rules, and we can see what this alternative interest rate feedback rule would have meant for the time path of inflation, output, and the policy rate. And then some models where you do have unemployment with unemployment, and we could see, did they make a difference in that way at looking at the data? You have already shown us these 6 policy rules make very little difference in terms of variances. But maybe if you look at the time path, it gives you something else that you can give an interpretation to. And within that setup, you could also ask, how would the path have looked different if we changed the steady state real interest rate as our way of having a crude capture of the fact that the natural rate of interest went down. Also, I have a specific comment about Hank. I think it is really nice to see that the team at the Bank of Canada has thought about different ways, maybe more realistic ways of modeling how the real interest rate affects private consumption choices rather than just a consumption saving choice. They went for a Hank specification, which means that some households are borrowing constraints, they face idiosyncratic income risk, and this income risk is uninsurable. In those setups, variations in the real interest rate change the budget sets of individual households, and so lowering real rates can be stimulating in that way. However, I would like, since this was the framework in which variances seem to depend on the interest rate feedback rule, price level targeting and nominal GDP targeting were somewhat dominant, I think it will be great if you want to push that line to address an issue that comes up in models with heterogeneous agents and incomplete markets, namely Ricardian equivalence no longer holds, and the effects of monetary policy are greatly influenced by what you assume about fiscal policy. I guess it's sort of natural to think that monetary policy is great at addressing normal rigidities in terms of prices and wages, say, but in this setup, the rigidities or the inefficiencies we have come from incomplete markets and idiosyncratic income risk. And so, and there's non-recurring equivalence, so people will think about, well, what about unemployment insurance? Do your results that price level targeting is useful? Does it depend on what you assume about unemployment insurance? What do you assume about disability insurance? What do you assume about retraining of displaced workers? So intuitively, it seems to me that in a heterogeneous agent model, we know that the effects of monetary policy depend a lot on what you assume about fiscal policy. So the result that price level targeting and nominal GDP targeting are dominated might not be robust to alternative assumptions about what fiscal policy are accompanying. And then
Stephanie, just to remind you that you have 5 minutes left.
Thank you.
Okay, thank you. All right. So the policies that this horse race compares are policies that are called history dependent, or I will call them policies that lead you to more forward guidance. As Reese really beautifully showed in his introduction to his talk, he said, well, if we go to a price level targeting, it means if inflation undershot in the past and we have a price level targeting, we know that inflation has to overshoot in the future. Again, why is that useful in an economic model? It is useful because it allows the central bank to engineer an effective lower real interest rate, even if it cannot lower the normal interest rate, since the real interest rate is just the difference between the normal interest rate and expected inflation. So these policies are somehow policies to give more forward guidance. It is logical to say there's a bigger interest in these type of policies nowadays, that we probably live in a world with a lower natural rate of interest. So I can see why those policies are considered attractive, because they allow you to more effectively lower the real interest rate in a crisis or in a recession. But I would also like to argue that has this kind of the implementation of these policies, as Reese said, comes in having lower normal interest rate for longer periods of time. So it's always lower for longer. And I want to just look at some data and say, is it actually true that lower for longer had the effect that it was hoped to have, namely that it raised inflation? And I'm going to say no. And the second thing is, could it be that lower for longer might jeopardize one of the precious goods that probably the Bank of Canada has achieved, namely very well anchored inflation expectations? Could it jeopardize it? So let me just show you the two cases. These are textbook cases. Maybe everybody who watches this says, I know this, but let me just point it out. So Japan is the number one, I think, showcase right now for lower rates for longer. As we all know, since 1995, the normal interest rate in Japan has been basically at zero, has been below 1% for sure. There have been booms and recessions. There have been some tepid attempts, maybe raising the interest rate by 25 or 50 basis points. But clearly, this has been a policy at lower for longer, basically near the zero lower bound for 25 years. If inflation expectations were well anchored at their official 2% inflation target, we should have seen that that policy, which is a forward guidance policy, or could be interpreted as a forward guidance policy, should have resulted in higher inflation. And this is GDP deflator, inflation as measured by the GDP deflator in Japan, and as probably everyone in this audience knows, Japan has never reached its inflation target of 2% over those 25 years. In fact, average inflation in Japan has been negative at around minus 0.5%. So this would be one data point. I don't want to say I'm doing econometrics, but there's one data point where lower rates for longer has not yielded higher in inflation. So the desired effect of lower for longer by raising inflation and therefore lowering real rates hasn't really come in. And the second example is from Europe, where I want to go one point further and say, has lower for longer really maybe jeopardized this precious good of well-anchored long-run inflation expectations? So here's the policy rate for Europe. This is the behavior since 2008. And so the ECB, like many central banks around the world, have at some point, 2008, the crisis comes. The normal interest rate is lowered. The normal interest rate has been below 1%, and most recently it has been negative. So the first question is lower for longer, has it led to inflation? And the second question, the one I'm more interested in here, is has it led to an unanchoring of long-run inflation expectations? And so this is inflation in the euro area, and we can see that inflation lower for longer has not brought inflation above the inflation target, which in the type of models that the simulations of the team at the Central Bank of Canada have, that model would predict that if you do a path like the one I just showed you for the normal interest rate, you should have had inflation exceeding the 2% target, and it never did. It just lingered around at around 1%. So it's another case that lower for longer need not mean that inflation exceeds the target. And this is the slide I want to close with. What has happened to inflation expectations? These are market-induced probabilities of inflation. And so there's a red line and a blue line. And the red line is the one that I'm interested in, which is what do auction prices in the euro tell us about the probability that over the next 10 years, say between 2020 and 2030, the inflation rate will be below 75 basis points. And you can see that this probability was about the same as the probability of the ECB overshooting its target by the same amount, that is to say about 3.25%, that's the blue line. But then, around 2015, there seemed to be an anchoring. The chance that they overshoot went to zero, but the chance that inflation would be on average over the next 10 years would be below 75 basis points went to 30%. So I think that's also a parallel about this idea of history dependence or lower or longer. It, again, just one data point, but it might lead to an unanchoring of inflation expectations. So let me conclude. In my view, inflation targeting the 2% target has been very successful in Canada. Inflation has been extremely stable. The secular decline in the neutral rate of interest is something that has been going on since the 1980s. It's not a new sudden decline in the last 5 years, and Canada seems to have been able to control inflation very well, even in this during this secular decline. And as we can see in this horse race results, if we do care about volatilities, it seems that maybe they bring some benefits changing the interest rate feedback rules, but they seem to be small. And yes, they might not hurt, but it's also not that clear that they will gain a lot. Okay, thank you very much.
Thank you to our three presenters. We'll now commence with our Q&A session. I'm going to invite Rhys Mendez to say a few words while he's making his way up to the stage. There was one observation that came in from, sorry about this, Lilia Karnazova at the University of Ottawa, and this is just an observation for Joe Gagnon's benefit. So we actually know there's been a lot of research done in the field of labor economics, and Professor Riddell from the Vancouver School of Economics is one person that's done work in this area. Just pointing out that, in fact, there are some important differences in how the rate of unemployment is measured in the U.S. and Canada. And so the chart that Joe showed a pretty prolonged period where the unemployment rate in Canada looked quite a bit higher than that in the United States on average. And so the point is just that these may not be completely comparable. And so once definitional differences are taken into account, the performance in Canada does end up looking somewhat better than the chart that Joe showed. So I'll just make sure that comment's out there so people are aware of it. So now I'll turn to Rhys.
Can I answer that?
Sure, Joe.
Can I answer that?
Oh, certainly. So this Pierre Fortin is going to add some comments here.
I'm following the advice of Carolyn Wilkins, who's saying that the key is to keep it simple. The simple comparison between the U.S. and Canadian unemployment rate is that in order to get comparable interest rate, you just subtract 1 point from the Canadian rate. In other words, 6% unemployment rate in Canada is 5% in the U.S. And that's because the measurement is a bit different, and also because there are 5 times as many people in prison or in the United States as in Canada.
Okay, great. Thank you very much, Pierre.
Oh, there's this one point, and that's that scan suggestion.
Okay, great. Thank you, Pierre. So I'm now going to go to Rhys and advise him to keep it brief in terms of making a few comments in response to the presentations we've had this morning.
Thanks, Sharon. So I just wanted to start by thanking all three all three discussants for their very helpful and insightful comments. I mean, these are the issues raised by the discussants will certainly influence how we move ahead going forward. So that's greatly appreciated. I wanted to pick up on a couple of things. So Joe raised the issue of raising the inflation target, and he made a compelling case for there being significant benefits from a higher inflation target. I think that the challenge, and Sharon, you alluded to this, I think in the end of the last Q&A session, when we looked at raising the inflation target in the past, the challenge is the transition. One of the big challenges is the transition. And actually the achievability and the credibility of being able to achieve say a 3 or 4% inflation target in an environment with very limited monetary policy space. And so I would be interested in hearing Joe's thoughts on how we would actually go about raising it. Pierre mentioned at the end of his presentation the possibility of temporary shifts to say average inflation targeting, and this is definitely something that we are thinking about. We've done work in the past on say temporary shifts to price level targeting, and in principle they're very effective because for a couple of reasons. One is at the effective lower bound, the extra stimulus you get from the lower for longer expectations outweigh the sort of issues that you get from the non-rational expectations in the model. So that in that sense, it works out well. More broadly, I think it goes to the asymmetry that Joe was talking about, in that deviations of say output or of output above potential or above steady state are different than deviations below. And I mean, a more formal way of thinking about that is to say that in an economy in which there are distortions, either because of distortionary taxes or monopoly power, et cetera, in an economy in which there are distortions, the efficient rate of output will be above the natural rate of output, right? And so deviations above the natural rate of output are less costly than deviations below. And so when you're at the lower bound, the price level targeting, even if you have agents who are very backward looking or not very rational, all that means is that you won't get the automatic boost from expectations. So you'll end up keeping rates lower for longer, and you'll have to push output higher in order to get the price level back up. So you'll have to cause a bigger boom in output in order to get the price level back up. But that's not really that costly if the efficient rate of output is above the natural rate of output. So I think that this idea of the temporary shifts is interesting. A couple of things I wanted to pick up on what Stephanie said. So in terms of the means, we didn't talk about it in the presentation, but in the simulations in which we have the occasionally binding ELB, there are mean differences. So for example, under inflation targeting, the mean inflation rate in the simulations is about 1.8%. So it doesn't actually hit 2% because you're below target during the ELB periods. And then when you're away from the ELB, you only go back to target. You don't overshoot. In contrast with the price level target, the mean inflation rate is 2% always. And so I think it's a good point. We should spend a little more time emphasizing those mean differences because they are important. In terms of whether or not the alternatives are really alternatives to inflation targeting, I agree that they all imply sort of a long-run expectation of 2% inflation. But they do imply really different dynamic responses over time. And so I think that and quite different behavior of the price level. And so I think although that they are similar and that they all imply the same long run expected inflation rate, the other differences are substantial enough that they are I would argue, material differences. And all three discussants mentioned the importance of thinking about nonlinear Phillips curves or downward nominal wage rigidity or some other variant. And that's certainly something that we agree with, and we do want to look, we are looking at.
Thanks, Reese. So the first question that has come in has to do with a higher inflation target. We've heard a lot of the benefits of a higher inflation target in some of the presentations. And so far, central banks have been cautious about implementing it. So this question can go either to panelists or to Reese. I'm going to read a lot, and then I will go back. I'd like to explore from the panelist point of view whether there are costs of higher inflation. And one classic view from Bailey is that inflation taxes monetary exchange and could therefore hurt output and employment. And I'm going to add on to that one because there's also been arguments that it's easier for wealthier and higher income households to hedge against higher inflation. And so that suggests that the higher inflation could have some undesirable impacts on either lower wealth or lower income households. It seems like this would mean that, in general, we're asking the more vulnerable households to always have to pay in order to provide more counter-cyclical space in bad periods. And those are some of the households that are already thinking that this monetary policy is disproportionately benefiting the wealthy. So there are a lot of issues associated with a higher inflation rate. I will go to Joe first, and then I will go on to Pierre, and then to Stephanie, and then finally to Reese on that question. So, Joe, do you have any comments on the higher inflation?
Yes, actually, two. One, Reese actually in his comments asked me to comment on this too. So his comment was, question was, well, how do we imagine getting there given that we're below target right now? And I want to abstract from the whole COVID crisis because I have no insights into that, and I just think that's just a whole different issue. But imagine we're back in December 2019 and sort of what do we do then? Well, I would say three things. First, I think New Zealand might be a good template to look at because New Zealand had inflation targeting centered around a 1% inflation and over time has raised it to 2% inflation. And how did they do that? And it did involve some legislation and dialogue between the bank and the Prime Minister and the government. So I think that may provide a template for Canada. I think the feeling in New Zealand was that this low target was really constraining the economy, and the bank wasn't paying enough attention to employment and activity. And I think those are the things we need to talk about. It's really that we want a better outcome for Canadians in terms of more employment and how important that is. That's the language that has to be used. I think the U.S. in December 2019 with unemployment at 3.5% and expected to go a little bit lower, if that had continued for another year or more, I think we would have seen inflation drifting above 2%, and that might have been a time for the Fed to make that transition. I agree that it's kind of hard to make it credible if you're below target already that you're going to raise the target. I don't have a good answer to that, except I think that moving to a price level targeting rule has the same problems because how can you credibly target a 2% rising path forever when you're not even hitting it? Same issue even if you don't raise the growth rate. It's a tough problem, but I would say talk about the benefits to workers. In terms of the second question that you raised to the participant, so I think the cost of inflation may hit low-income people more. I'm not sure that's true. Yes, cash in their wallets and maybe zero-interest bank accounts might be a higher share of their assets, but they tend to be debtors. And if they have low interest rates, I mean, it's not clear to me how that works. Overall, I think that's a small number in terms of the actual cost to their living standard. I think I think you do a sort of this is like a Harburg triangle versus open gap thing. I think what you find is that the benefit to low-income workers of a high-pressure labor market where unemployment is lower are disproportionately high on the low-income side of the spectrum, and those gains, I'm certain, are multiple times any cost from a little minor, tiny increase in the tax on the tiny amount of cash they carry around. Getting a job just dwarfs that by probably 2 or 3 orders of magnitude. And this is what Jay Powell has been talking about, and I think he's right. We just see how the low unemployment rate below 4% in the U.S. is disproportionately benefiting the people at the bottom. And that's what we need to focus on.
Thanks, Joe. I'm mindful of the time. It's partly my fault for asking a complicated question, but I'm going to pass it across to Pierre if you have anything to say, and please keep it brief.
Okay, my turn?
Yes.
First, there is the question of planning. We want to have low inflation in order to be better able to plan for the future. I've not seen in the literature of the past 40 years anything that says that the cost of going from 2 to 4 would be terribly important, first of all. Second are distributional effects that may be of concern, especially during the transition from 2% to 4% to return to Ricardo's preoccupation last moment. But the low-income elderly would be protected because the GIS, the Guaranteed Income Supplement, and the old age pensions are all indexed. It would be middle-income elderly that, like Bill Robson, for example, who would be would perhaps, if I don't know his pension plan is indexed to the cost of living, who could be hurt in the transition. Definitely. But on the other hand, of course, you have to balance that against the benefits of getting to 4%. And the reason why we would like to go to 4% is that we want to close those huge open gaps that cannot be closed as easily when you have 2% inflation that squeezes monetary stimulus too much.
Thank you, Pierre. Stephanie.
Yeah. I think intuitively one would think, oh yes, I go to an inflation target of 4% instead of 2%, so I'm going to hit the zero lower bound much less often, and that is greatly welfare increasing. So as I think the study from the Bank of Canada shows, it will be interesting to ask how big is really the cost of hitting the zero lower bound, how many tools do we have to avoid it. And then one of the things that I think has been a little bit in the background here, but that I think is important for a central bank like Canada. Canada is a very open economy, and there can be big variations in relative prices in the directions towards bringing about more efficient allocations, and particularly bringing about wages that are consistent with full employment through variations in the nominal exchange rate. And so we can have those going on occasion to offset a shock without having on average higher inflation. I mean, for example, in this work that I have done with Martin Uribe on open economies with downward nominal wage rigidities that are subject to external shocks, it turns out that the welfare maximizing policy ends up being one in which the steady-state inflation rate can be as low as 0, and nevertheless you can obtain full employment at all times by a rule in which the nominal interest rate almost never moves, and all the adjustment of bringing about efficient relative prices and guaranteeing full employment is one in which the nominal exchange rate moves. That is to say, if you have a central bank that is willing to see the exchange rate sometimes adjust, but you at the same time you are fine with an inflation target that is low, say 2%, and with a pretty smooth nominal interest rate, in that type of models, you can get the efficient full employment allocation, and the variable that you would see moving, and hopefully you're comfortable with that, is the normal exchange rate. So I think even though it's super intuitive to think, oh yeah, let's have a higher inflation target that's going to move us further away from the zero lower bound, from my own experience in modeling, surprisingly enough, this intuition doesn't bear out, because in the open economy, you can have stable inflation, stable normal interest rates, but big movements in the normal exchange rate that does the adjustment that we need. Thanks, Stephanie. And Reese, I'm going to offer to you the final word.
Thanks, Sharon. So I would just add one thing. I think when I think about the costs of a higher inflation rate, I worry more about the transition costs than the steady state costs. And we talked a bit about the transition costs over the course of the day already. I would just add one additional thing that we haven't really talked about, and that's the redistribution that comes about when you change the inflation target. So we had done some work for the 2016 renewal when we looked at the possibility of raising the inflation target that found that for every 1 percentage point increase in the inflation target, the household sector would lose wealth equal to about 4% of GDP. And so, if you went to a 4% inflation target, the household sector would lose wealth equal to about 8% of GDP. The reason the household sector is taking the loss is the household sector is a big holder of longer-term assets and unindexed pensions. And now, in principle, the government actually ends up being a net beneficiary because the government issues a lot of long-term debt and could redistribute this in a way that's neutral. In practice, that would be quite hard to do, I think, and so that the redistribution would end up being quite inefficient. And that's one thing that, although it's not a steady state cost, I think it's something we need to keep in mind.
Thank you, Reese. So thank you once again to our presenters and participants for this first session. We'll now break for lunch or dinner, depending on where you're joining us from. We'll resume the conference at 2 p.m. Eastern Time. If you have registered for a breakout session, you will have received a separate link and instructions on how to join in your confirmation email. You will need to exit and quit this WebEx meeting and log into the breakout session you've registered for, which will start at 1:15. You cannot have both WebEx meetings open at the same time. For anyone logging off the WebEx meeting for lunch, please rejoin the meeting a few minutes before we start at 2 p.m. Eastern Time. If you have any technical issues when trying to join these sessions, please email multimedia@bankofcanada.ca.
Research Officer in the Economic and Financial Research Department at the Bank of Canada, and I am chairing this second session titled Policy Coordination, Lesson from the COVID Crisis. This session seeks to examine the potential lessons from the current crisis for the complementarities between monetary policy, fiscal policy, as well as macroprudential policies. Joining us today as discussant for this session are two leading experts, Ricardo Rice and Martin Eichenbaum. Ricardo Rice is the A.W. Phillips Professor of Economics at the London School of Economics and the Director of the Centre for Macroeconomics in the UK. Martin Eichenbaum is the Charles Moscos Professor of Economics and the co-director of the Center for International Economics. Both our speakers have written influential and highly cited work on these questions, and we look forward to hearing their thoughts today. Welcome back to both of you virtually to the bank. For each presentation, we have allocated 20 minutes, followed by 20 minutes for questions. We encourage questions from the audience during the presentation. Please send your questions using the chat function on the right-hand side of your screen at any time during the presentation. Please remember, when sending your question, to direct it to all panelists. in the drop-down panel. My colleagues are now putting those instructions in the chat box. The question will be compiled and asked after both presentations, and they will be asked by my colleague, Sharon Kozicki. Now, I would like to turn things over to Ricardo. Ricardo Ruiz from London School of Economics. To remind you, we have allocated 20 minutes for your presentation, and we will give you a polite and gentle reminder when we have 5 minutes left. Thank you, Ricardo. The floor is yours.
Thank you very much. Let me switch on the slides here, and perfect. Can you confirm you can see my slides there?
Yes, you can see your slides.
Okay. Well, thank you very much for having me. It's really a pleasure to be here. My mandate for this talk was to talk about policy interactions post-pandemic. Now, it is both trivial as well as deep, if you want, but certainly not very useful to say that anyone well-trained in the macroeconomics, or better, in general equilibrium, that all policies interact in achieving the multiple outcomes that policies, the multiple objectives that policies have, as well as the multiple outcomes that economies generate. So there's always such interactions. Likewise, I don't think I'm being controversial in saying that the COVID pandemic has been such an aggregate shock that it has really changed our life in society and in economic life in a multitude of dimensions. It has changed the way we interact in public, the way we trade, the way we produce, and the way in which the different sectors of economic activity work. So there's a sense in which the answer to this question is very easy. All policies interact. Post-pandemic, those interactions have definitely changed. More concretely, though, and when it comes to the Bank of Canada, the key interactions that I want to focus on, and which I think are relevant, are the interactions between monetary policy, as is the mandate of the bank, financial policy, as is the mandate of the Office of Superintendent of Financial Institutions, so OSFI, together in part with the Ministry of Finance, and finally, the fiscal policy that is the mandate of, obviously, the Treasurer or the Ministry of Finance. So it's interaction between the financial policy, if you want, monetary policy and fiscal policy that I want to discuss, especially in the light of the mandate of the Bank of Canada. And in that interaction between those three dimensions of policy, I would like to draw your attention, or I would like to talk about the following 4 new challenges that are raised by COVID or the current recession. Number 1 here on the left, the record high public debt. This graph comes from the Wall Street Journal a couple of days ago. And just to note that the level of public debt is now already above that at the end of World War II, which is unprecedented record high public debt. How will these 3 forms of policy interact in a world that, certainly for the next few years, is going to be characterized by very high debt? Second, that private defaults are most likely, a wave of private defaults is most likely arising. If one looks at the spreads in corporate bonds, not just the high yield, but also investment grade, they're all elevated, as it is expected that the rise in private credit of the last few months will surely lead to some wave of corporate bankruptcies and defaults in the near future. How will these policies interact in an environment in which, over the next year, we will go through some defaults and corporate bankruptcies? And, one remarkable factor, by the way, is in the United States, there are 350 corporate bankruptcy judges, 350 for the entire country. They're going to have to handle all of the hotels and restaurants. They're going to have to close their doors over the next 24 months. Third fact, that even though we see a large contraction in retail sales data for the UK this year in the last few months relative to what we had seen a year before, in online shopping, instead, sales have increased relative to a year ago, even in spite of the recession and even in absolute terms, and all of these are done with digital payments. How do we think about the role of central bank interaction with financial institutions when the economy is becoming more digital in the use of currency? And finally, fourth, that market expectation, longer expected inflation, as measured by here the 10-year break-even, fell initially, but now have recovered, whereas the household ones have been almost unchanged. This is from the Michigan survey. And so we'll be getting inflation, deflation, or rather, as these longer expectations of inflation seem to reveal, stability. So these are the 4 challenges that I want to address in terms of, and solely in terms of, these are, of course, very large challenges for macro policy in general. I want to talk simply about how do they change the policy interactions. Let me start with the first one, the high public debt. The fiscal footprint of monetary policy can be defined very precisely as how much does the government budget constraint tighten following a monetary policy action. If one thinks about the market for government bonds, where Q is its price and B is the quantity held in the private sector, which is going to be the residual of the total supply by the government minus whatever is being held by the central bank, then we have that either a conventional monetary policy that lowers short-term interest rates and shifts the demand out, or non-conventional monetary policy that buys some of the bonds and therefore shifts the effect of supply to the left, both result in a higher price for the government bonds the government sells. This is not a small effect, and it is an immediate direct effect of monetary policy. Now, this effect is larger the larger is the amount of government debt. That is, I am saying the perhaps obvious point that with a large amount of debt, any rise in interest rates by the Bank of Canada has a very big impact on the accounts of the Ministry of Finance. And it impacts it immediately through the issuance of debt and the price at which the Ministry of Finance is able to sell that debt. Indirectly also, the larger is the public debt, the larger the effect that monetary policy by affecting output, and insofar as taxes as a proportion of output, therefore surpluses are going to be also a fraction of that, and as a result, the larger is the government debt. Likewise, the indirect effects of monetary policy on the debt, if the debt is higher relative to GDP, are going to be higher. In short, the fiscal footprint is higher when the public debt is high. If your public debt is 30 or 40%, it is very easy for the Treasury to say, I will give the central bank independence. But now that the debt is at the level of World War II, at the end of almost every significant war that I know of, in my knowledge of monetary history of the last 150 years, what followed after a war was no independence in the central bank, or rather the central bank becoming dependent of the Ministry of Finance and dependent particularly to the objective of minimizing the fiscal footprint that its actions would take. How is that minimized? Well, the conventional thing that monetary history teaches us, and let me use here the example of the U.S. monetary history, just because that perhaps may be slightly more familiar, but this is remarkable how this is the story that happens over and over after wars, is that the Treasury tells the central bank to simply have a ceiling on long-term interest rates. In the case of the Federal Reserve, the ceiling was 2.5% on the 10-year yield. The central bank stands ready to buy and sell 10-year treasuries using whatever tools it has, but more importantly, using what today we would call QE, at the time was called credit policy and management of the central bank balance sheet, in order to make sure that the Treasury can keep on rolling over its debt and supporting the large expenses and the large debt burden. Now, what happens eventually is that may work well for a few years, and in the U.S. it worked well from 1942 to 47, but eventually, as happened at the end of 47, that ceiling becomes close to become binding. And at that point, the central bank's commitment to the ceiling means that it loses control of the size and composition of its balance sheet, which then fluctuates, as it did between 47 and 1950, wildly between long-term and short-term bonds, depending on precisely whether the constraint becomes more or less binding. During this time, what one observes as well is not only that the central bank loses control of the composition of its assets, but also that near its ceiling, inflation becomes very volatile. And why is this? The theory of this is in some ways well understood, even though usually not formulated this way. Most economists are familiar with the theory of zero lower bounds. For instance, Stephanie Schmidt-Groyer, who spoke earlier, did seminal contributions to the study, where we have a floor on the policy rule interest rates can't go below zero. Well, if one has a ceiling on long-term interest rates, that translates to a ceiling on short-term rates, properly translated, and as a result to the emergence of not just an equilibrium of 2% inflation, but also an equilibrium of potentially higher inflation and a stable equilibrium at that. And the history of the United States between 47 and 51 can be seen as a history of converging towards that high inflation equilibrium or converging back to the low inflation equilibrium and the instability associated with it. That is, high public debt and interest rate ceilings comes with loss of control of the asset composition, eventually binding ceiling, and the de-anchor of inflation. Then in the case of the U.S., only came with the removal of that ceiling and the independence of the central bank in 1951 with the Accord. Now, beyond that, though, keeping interest rates low is the way to manage the debt. How do you pay for the debt? Well, if you're not lucky to grow out of it, as happened in part to the U.S., the typical way in which war-level debts are paid, and again, monetary history shows this very clearly, is by financial repression. And what is financial repression? in a very short, is financial regulation that forces financial institutions to hold long-term government bonds. In doing so, the government makes sure that there's not a debt crisis and gets whatever you may want to call liquidity, a regulatory premium, and a no default premium. But either way, the Treasury is able to sell its bonds at a higher price. Why? Because it has a captive demand there. Once financial institutions are forced to hold these long-term bonds, then a little bit of extra inflation for a long time lowers the real value of the debt, and the debt gets inflated away. In the UK, this was the history from the 1950s to 1980s. And at the time, this financial regulation had the fancy name of the Ratcliffe credit policies and the Ratcliffe regime. In the US, we saw this in part in the 1970s, where ceilings on deposit rates, together with, again, aggressive financial regulation by the Federal Reserve, allowed through inflation to some of the debt to be deflated away. And in Latin America, we saw this in the 80s quite extensively across many countries through the use instead of reserve requirements, which essentially use Reserve of the Central Bank as an infinite maturity console that would pay a below market rate in order to, again, go through the same inflating of the debt. Now, in those circumstances, what are the three important interactions between monetary policy and financial repression? First is that a policymaker that cares about fiscal, if there's fiscal dominance, if that's present bias, then doing more regulation that allows me to push the problem of a fiscal crisis to the future is always preferred, even if it leads to a contraction in output and fiscal surpluses through the lending contraction that reveals. A present bias policymaker will want tighter financial repression, even if it induces a repression. Second, if we have a financial crisis, again, we want more financial regulation because the financial regulator will want to do more repression to lower the bailout costs of a crisis. And finally, thirdly, there is what I called in a paper recently an unpleasant fiscal arithmetics, whereby if the fiscal authority behaves in a fiscally irresponsible way, then the financial authority wants to itself engage in financial repression in order to avoid the fiscal crisis, which would inevitably lead to a financial crisis. So a financial authority that wants to avoid a financial crisis wants to avoid a fiscal crisis, and it does so only by engaging in financial repression that raises the fiscal benefits. So, second challenge, corporate defaults. Here is a picture of bankruptcy filings in the US, and you see here the rise already in May of 2020. Where were these recently? Mostly in consumer discretionary spending, but the question is to the extent to which these are going to be much larger over the next 12 and 24 months, even if only through a reallocation across activities. Now, as corporates default, banks get in trouble, and indeed, the stock price of banks has fallen, and during the height of the crisis, we saw an increase in the perceived risk of lending unsecured to a bank as opposed to secured, although that has fallen quite significantly. Why has that fallen? Well, partly because one would argue that in the current environment, there's quite a lot of trust that the U.S., the Federal Reserve, would step in to provide lender of last resort to the banks. The Federal Reserve was quite clear they would do that. And moreover, the Treasury, having bailed out so many firms, would likewise bail out banks as well. That is, the bailout guarantees seem to be back in some regards. Now, let's think about the interactions of the central bank of the lender of last resort and fiscal policy. The theory of the lending of last resort, most people know from Badgett, is that one should lend to banks that are illiquid and yet solvent. Everyone knows that first part, but there's a very important second part. And the second part, which was well discussed by Badgett, and even more importantly by Thornton a few years before Badgett, of course, most of the ideas come from a book a few years earlier by Henry Thornton. One wants to lend to the liquid and solvent, but very often the illiquid becomes insolvent. And as important as that first rule is that the central bank is ready to step out immediately when the illiquid becomes insolvent and calls the Treasury for then we're in bailout land. And when it comes to a bailout, this is inherently a fiscal operation. Lending of last resort can quickly become a bailout. Now, this means that there is no well-conceived lender of last resort without enormous coordination with the fiscal authority. There are many lessons to be drawn from the European experience of the last 10 years, precisely because having created a European central bank that was very independent, was so independent of this authority that even in this lender of last resort, it was as much independent as it was incomplete, the European architecture of how would be the relation between the ECB and the fiscal authorities. And so what we saw was that in a few isolated banks in small countries, the ECB triggered, removed indeed lending last resort very quickly, as soon as the institutions in those countries' banks seemed to become insolvent, and in doing so led to enormous costs to the taxpayers of those countries. When it came instead to the larger banks, and when there was a systemic crisis a few months later, instead the ECB did not remove lending last resort, but instead worked through reforms and through the financial regulators in order to minimize the fiscal costs to Italy in particular, as well as France and others. That is, what you see is that this coordination is extremely important, and different forms of coordination lead to very different outcomes. But you cannot undertake a lending last resort significant scale with office support. Insofar as corporate bankruptcies are going to lead to banks in trouble and lending last resort, coordination with the fiscal authority becomes important, if not even essential. Moreover, in a scenario of fiscal crisis, if that of lender of last resort and fiscal crisis interaction, then quantitative easing becomes a very powerful tool in ways that are often unappreciated. In this graph here, what I have is a trade-off between the recovery rate on government bonds and the size of a potential bailout. The larger is the bailout T, the worse the hole in the government budget, and therefore the lower the recovery rate on bonds, or if you want, the lower the probability of repayment, and thus the green downward sloping line. But at the same time, the larger is the failure of bonds, or the risk, if you want, on government bonds, then because banks often hold many of these bonds, this means also a larger bailout. Or even if only because the larger the fiscal crisis, that is the lowest delta, the more the recession, and the more, again, the chance for a financial crisis that leads to a higher bailout. And thus you get a likewise red downward sloping line, the bailout line as I call it here. Now in this circumstance, QE, when you have a shock, any shock or recession like we have, you will have a propagation because of the interaction of the budget with the bailout. But importantly, QE that swaps bonds and reserves, and here I put the opposite, the reverse of QE, amplifies the crisis. And why does it do that? Because the QE that gives QE in this case that gives banks reserves in exchange for bonds, insofar as reserves default less and are more insulated from default crisis than government bonds. And this is something we always observe, that government default risk always comes as a premium over liabilities of the central bank. What that implies is that by doing so, QE lowers this amplification, and QE is an effective way to insulate the banking system and the financial system from the corporate default wave and the recession that comes. More generally, reserves are special in the fiscal crisis. Why? Because reserves can only be held by banks, and reserves have a lower default risk than government bonds. In particular, they have a lower default risk insofar as they're the unit of account. Therefore, by engaging in QE,
about 5 minutes left. Sorry to interrupt.
By engaging in QE, the central bank can, if you want, insulate the financial system from the default risk, and therefore QE becomes is particularly powerful in the fiscal crisis. Third challenge and third interaction, the rise of the digital. I already showed you how digital currency has increased. First of all, let me do a note. Cash has not disappeared. To my great surprise, actually, this is data for the UK, this is currency circulation for the US. Cash withdrawals currency circulation have actually increased quite a lot in the last few months. So people are using more cash or at least hoarding more cash, and while at the same time using more digital currency. The challenge here is to what extent we will have the emergence of digital forms of currency that compromise the ability of the central bank, and in particular the control it has over the monetary transmission mechanism. Now, importantly though, what the last few months have shown was that in some ways the developments here are somewhat different from what were discussed 12 or 24 months ago. First, that the majority of these payments are still using the interbank settlement provided by the central bank. Unlike Bitcoin, most of the digital payments have happened through providers who use the settlement mechanisms provided by the central bank. Likewise, the rise in digital payments has, if anything, happened nowadays with stable coins, which still use the government currency as the unit of account. Combining these two features means that central banks have remained, and if anything, became more crucial and central in what seems to be the digital payments architecture. In the Eurozone, TIPS, which stands for the Target Interpayment System, has been a remarkable success, which was introduced just 2 years ago, was a remarkable success in allowing for this digital payments because it allowed all kinds of new fintechs to be able to engage in settlement at the central bank instantly, and has led to a huge boom of digital payments, and a particularly large one relative to many other places in the world. Moreover, reserves, the central bank, are not only still the unit of account, given the stable coins, but also the store of value of last resort. Now, insofar as banks are the way to access reserves, for the economy to access reserves, that means that banks continue to have become, if anything, as central or more central to the financial system. But this raises the issue that as central bank issued accounts, i.e. reserves, become important, it is not the case that central bank digital currency disintermediates or destroys some of the banks. For the opening of that account still comes with the knowing your customer regulations for which banks or the financial institutions must play a role. The real question that has arisen in the last few months, or not the real one, there's many questions, but an important one, has been that the central bank must choose in the issue of the central bank digital currency is whether to provide access to the central bank only to banks or to other institutions, given that this will lead to a trade-off between allowing for competition in payment systems or potentially stability. Competition is always destabilizing, but it is also welfare enhancing and productivity increasing. Finally, fourth, and to conclude with inflation, since to talk about policy interactions without mentioning inflation for an inflation targeting central bank would obviously be incomplete. Right now, we seem to, as I showed you in those picture inflation notations, be taking advantage of this remarkable capital that central banks and advanced economies, including the Bank of Canada, have gained over 20 years. Households are remarkably inattentive. They expect 2%. Inflation notations, as Joe Gannon mentioned earlier, are unbelievably anchored, way more anchored than any rational expectations agent would have. And as a result, inflation is very anchored in the 0, 1, 2% range. That is the situation which we're now, and so we had already puzzled in 2010-12 at the flat Phillips curve. We are seeing it yet again, but it comes from the inattention of households and the capital built by central banks. And a good thing it is. At the same time, it is easy to use economic theory, or even just common sense, to see that the high public debt, the fiscal crisis needs, and the potential interaction I discussed earlier between monetary policy and fiscal policy to come under stress, and as a result, for inflation to be tolerated until an accord and a new independence arises. So the inflation trap equilibrium is eminently sensible. At the same time, a deflation trap equilibrium, where a recession plus a rise in what Keynes called animal spirits, but today we'd call precautionary savings, given the great uncertainty of the recession, would decrease aggregate demand, and where the zero lower bound preventing a policy response would lead to a deflationary equilibrium. It seems to be perfectly plausible for the economic theorists that all three of these would emerge. In the data, I see the first one, the good equilibrium. And I think I think the benefits of inflation targeting, even as today we discussed potentially abandoning it, as we were discussing at the beginning of the session, have, if anything, been felt today. The dilemma, though, is that the more we discuss them, in some ways, these other two equilibrium become potentially more active. So, in my last 20 seconds, but I'll take 45.
Yeah.
What are how do these new challenges put pressure on separation? The high public debt puts pressure to support the Treasury in paying for it, both by monetary policy and by the financial regulator, repressor. There's an interaction between fiscal and financial and monetary. The potential banking crisis puts pressure on using QE and the size of the balance sheet, as well as on the lender of last resort, both to ameliorate the banking crisis as well as to manage it. An interaction between financial and fiscal regulators, together with the monetary, of course. The digital economy puts pressure to reduce central bank digital currency and open access to central banks, so that financial stability becomes was run by the OSFI in Canada, becomes intertwined with the central bank digital currency access decided by the Bank of Canada. And finally, inflation puts pressure to focus attention away from inflation, and thus a conflict, if you want, with a mandate for inflation is well anchored at 2, and let's keep it well anchored at 2, not change any mandate, not create any regime shift. In general, macro process to be coordinated. Specifically, I would conclude by saying that the central banking of the last 10 years, what is sometimes we call new central banking, is much closer to the future norm than the pre-2008 world. And that new norm, new central banking, has been about thinking not of central bank as having monetary policy, inflation targeting, separate from fiscal and financial policy, but from having very strong policy interactions, which should lead us to question the way in which we think of inflation targeting central banks. Thank you.
Thank you, Ricardo. So now we will turn the floor to our next speaker, Martin Eichenbaum from London, from Northwestern. Again, to remind you, we have allocated 20 minutes, and I will also interrupt you politely 5 minutes before.
Thank you.
Thank you, Martin. The floor is yours here.
Thanks. I'm just trying to share the file.
Okay.
Right. Sorry about that.
No problem.
I'm loading the file. I have no idea what will happen, but I don't know why this is quite so complicated. While this is happening, why don't I just begin? It seems to be taking a long time.
So one possibility could be if we cannot load, we can put your presentation and then we tell the number of slides. Oh, it's coming.
Now it loaded Ricardo's presentation for some reason.
Oh, that's Ricardo, yeah.
That's quite bizarre. Okay, well, do you have my presentation just so that we don't waste people's times? And I can just ask,
Kevin,
why this
can
is...
you put... Okay, I think it's here.
Okay. All right, great. Okay.
Yeah, your slide right here. Okay, perfect.
Thank you very much. Sorry for the delay.
Yeah.
First, it's a pleasure to be here, and it's actually terrific to follow Ricardo because, as you'll see, in some very important ways, we, I think, complement and agree with each other. Let me start off by saying I think that the COVID crisis is truly an extraordinary event, which led to extraordinary central bank actions, partly in response, in support of extraordinary fiscal actions. So I wanted to make today, were really three key points, one of which is a short-run point, another is an intermediate point, and the third is really a challenge, I think. The first point is that the extraordinary central bank actions were justified because of the very special characteristics of the COVID crisis. The second point is that the crisis has exacerbated pre-existing threats to central bank independence. And third, and maybe most importantly, is that discussions about the right monetary policy framework really can no longer be conducted without a discussion of our fiscal policy framework. So first, why is COVID so special, and why is the policy response somewhat special? Well, the first is, as researchers, we often think about what's the shock. Well, there's no mystery in this one. This one's easy to point to. But it is both an aggregate demand and an aggregate supply shock. The supply shock is simply that the epidemic exposes people who are working to the virus, and people react to that risk by reducing their labor supply. The demand effect is that the epidemic exposes people who are purchasing consumption goods to the virus, and people react to that risk by reducing their consumption. So supply and demand are both working together to generate a very large and persistent recession. So from the perspective of economics, we would have had a severe recession even if the government hadn't instituted any containment policies at all. And in fact, there's a great deal and growing evidence in support of the view that these basic economic mechanisms were very powerful and a very central part of the way the economy is responding to COVID. Now, in a normal recession, policy is focused on just boosting aggregate demand, right? That's what we want to do. We call the firemen, and they do what they're supposed to do. But that is exactly what you don't want to do, certainly in the initial and maybe middle stages of a pandemic. There's a fundamental Pigouvian externality associated with epidemics, which is that people don't fully...
Hey, Marty.
Yes?
Excuse me, Marty. We only have your first slide. I don't know if that's on purpose.
No,
okay.
No, I'm holding off. I'm trying not to zoom through many slides.
Okay, good. We just want to make sure. Okay.
No, it's the new Marty where I have less slides than minutes.
Okay, good. Okay.
I'm going to get there.
Okay, let's go. Yeah.
So with this infection externality, it's no different than a pollution externality. What policy needs to do in the initial throes of the pandemic is to slow the economy down critically while minimizing current long-term damage to the economy. And that type of policy, because of the tax revenue implications and because of the expenditures implications, good policy comes with very, very large very large fiscal costs. So in a very simple measures, which I'll show you in just a moment, where you simply cut down consumption and impose market restrictions in a way that doesn't distinguish between health status or age status, you have a very sharp trade-off between economics and health in the short run, and there are much smarter ways to do it, which we can talk about. The very simplest framework that I'll just talk about briefly is based on classic work by Kermick and McKendrick, where you imagine that the economy is four groups: people who are susceptible to the disease, people who are infected, people who have recovered from the disease, and deceased. If we could just now finally switch the slide. Okay, so the idea is that people interact in goods and labor markets, and their new infections arise from a variety of social interactions, non-economic ones, consumption-based activities, and work-related activities. Susceptible people can become infected. Infected people can recover or die, and people react to the risk of becoming infected. And there is remarkable evidence, which we're currently gathering from very micro data, about how different groups, depending on the implications of an infection for them, differentially reacted to the crisis. If you just switch the slide now to the next slide, I'll be very brief, and then let's go on to the next one, if that's okay. Okay, so what I have here is simulations from a model, which actually turned out to be reasonably accurate. And this is, in the blue, you have a benchmark model with no government intervention. And what you see is a, rise in infections. You're all familiar with these kinds of graphs now, unfortunately, a lot of deaths. And for our purposes today, a substantial reduction in economic activity here measured by consumption. Now, you might ask, what should the government do in the face of this? Well, normally we say, oh my goodness, there's a contraction. Let's do what monetary policy people do, and let's boost economic activity. But that's not the right thing to do here because of the Pigouvian externality. So the dotted line actually exhibits what is the, quote, socially optimal policy, subject to the constraints that you are not discriminating between groups. And here you see that you get an even larger reduction in consumption. That's the dotted line relative to the blue line. Why do you do it? Well, you do it because you get a much smaller number of deaths. But what you want to notice here is a very sharp trade-off, a much sharper contraction in return for a sharp reduction in deaths. And the whole trick about smart health policy is to minimize those reductions or those trade-offs. Now, the real world, when we go beyond the model, is we know that actual recessions create inefficient economic losses. It's easy to think about what those are. Destructions of firms and jobs lead to loss of firm-specific and human capital, and in the worst case, workers becoming disinterested. over this COVID crisis. And the trick here is to balance inefficient job loss with the appropriate and required. But Canada responded, I think, quite admirably with a massive fiscal expansion and a massive monetary policy that really responded in absolutely unprecedented ways. So if you just financing the bridge, and this is just taken from Canadian data, and you can see the very large change in the unprecedented and will result in debt levels that you'd have to go to World War II to have anything akin to, but perhaps that's the right analogy that we are in somewhat of a war situation. Now, in November of 2017, at a previous Target Renewal Consultation Conference, I argued that the zero lower bound future than in the past. And I argued that price level targeting or forward guidance were unlikely as we come out of the worst part of the COVID crisis. I will argue that the future is now. The ZLB is binding in Canada and will almost surely bind when we're definitively over that COVID bridge. The zero lower bound constraint is under a variety of assumptions. And as you can see, under the most optimistic of assumptions, now, the question then becomes, as we think about post-bridge options, how do they interact with central bank independence? Well, we talked a lot today about quantitative much and for how long can Canada affect the real yield curve at various maturity. Definitive evidence on that, but it's much more likely that lower nominal long bond yields would have an expansion rate for consequences that elected officials, the public, and the U.S. will care about. Policy that finance would have every right to have a say in and would certainly insist upon it. Well, you might say, well, politics becomes much more difficult, and inevitably the question becomes who wins and who loses from such central bank option. intermediaries' capital position and their lending capacities. And as has already been mentioned, they would almost certainly promote targeting, which Reese talked about in a very, very interesting paper. And here I want to just, if you could turn the slide now. Of under 1 percentage point. And so the question we have to realistically ask is, what could you possibly hope to get with quantitative easing? You might push it down another 50 basis points. What could you plausibly get with forward guidance? What could you plausibly get now with price level targeting, which is really just a fancy way of implementing forward guidance? So let me step back from all of that. There's the old world. What was the old world? And Ricardo, I guess, maybe talked about it as pre-2008. Well, the old world was interest rates were comfortably well hedged. The ratio of government debt to GDP was modest. And the fiscal impacts of monetary policy actions were largely uncontroversial. So we, central banks, could easily carry out our mission without much public discussion of fiscal policy. Outside of a relatively small circle of people paid much attention to what we're doing, and that's when things are going, well, that's great. What is the post-COVID world? Well, even more so than after the financial crisis, short and long-term interest rates are low. Central bank balance sheets are not particularly well hedged. As Ricardo showed, there's been a dramatic worldwide rise in government debt to GDP. And so I conclude that in the post-COVID world, the bank simply has to explain the connections between monetary and fiscal policy and, significantly, the limits on its ability to control inflation without appropriate fiscal support. To be concrete, what are the dangers to our inflation target if we say we want to hit 2%, never mind 4%? Well, there are dangers on the downside and there are dangers on the upside. What are the dangers on the downside? Well, there's no automatic stabilizing mechanism to bring the economy back to target inflation and stay there in the face of further shocks unless there's a widely understood commitment to use fiscal expansion at very low interest rates or when the ZLB binds. There are also real dangers on the upside. We are going to get over the COVID recession at some point. But, as Ricardo emphasized, a rise in interest rates will lead to expenses on interest rates that hit historically high levels. And politicians will almost surely turn to questioning monetary policy decisions because of their impact on the budget.
Marty, you have 5 minutes left. Thanks.
Perfect, thank you. So I want to really talk about the two policy challenges. One is, if you accept my premise, which you may or may not, monetary policy will simply be of less relevance in isolation to achieve inflation targets. And one way or the other, we are going to have to come up with a practical framework for using fiscal policy when we need it and not using it when we don't. I would argue that as part of the discussions of the bank, perhaps not this time, I'm not sure how tight the constraints are, but we need to get this discussion going. I would like to see the bank, as part of a grand bargain, at least engage the fiscal authority on commitments to three things. A flexible debt to GDP target. What are the fiscal authorities' view of where fiscal debt to GDP ratios ought to be, federal and provincial? I would like, as part of that bargain, the fiscal authority to reinforce its commitment and support of a bank's flexible inflation target. And finally, and most controversially, I would like to see a commitment to the expanded use of fiscal policy when we've hit the practical limits of monetary policy. I've argued that the first leg in that policy, I've called it unconventional fiscal policy, would be a program of asymmetric automatic stabilizer programs. The second leg would be an asymmetric automatic change in tax rates, and that both of those legs would kick in when easy to measure and simple to communicate macro variables hit pre-specified targets. The obvious trigger is the bank's policy rate, but for various political reasons, we might not want to do that. But we would want to have an explicit agreement with the fiscal authorities about the trigger, be it a moving average of unemployment, real GDP, et cetera, of when those asymmetric policy things kick in. The brief case, and I will end very soon, is fiscal policy is likely to be very powerful in a deep recession when the ZLB is binding. You don't get that necessarily out of conventional models. You really need a combination of ZLB binding and Hank models. And in those kind of models, you can rationalize strong asymmetric automatic stabilizers like unemployment benefits and also asymmetric moves in tax rates. These stabilizers and tax cuts are triggered on and off by economic conditions. So it's not just important that they begin when they're needed, but they end when they're not. And that's why I think it's so critical to get the finance and hope in the best of worlds, the government to agree. Another very important advantage is we get to decide them or talk about them now when we're not in a crisis. And fourth and finally, to the extent that these things are embedded in explicit agreements and in an ideal world by law, people, agents, governments could count on them. And that would have particularly important effects on their precautionary savings to the extent that they can count on this help when it's needed. That would reduce precautionary savings at a time exactly when we don't need it. So if we could just switch the slide now, and I will end. I want to conclude by pointing out that the Bank of Canada was a leader in developing inflation targeting. And that strategy was about as close to perfect as you can imagine for a world in which policy amounted to fine-tuning, and that is not belittling in any way, fine-tuning interest rates in coordination with financial regulation. I think now the empirical prerequisites for that strategy of monetary policy operating in splendid isolation simply aren't with us anymore. Interest rates along the whole yield curve are simply too low and deficits are too high. So we'll end by paraphrasing Keynes. When the facts change, I change my framework. What do you do? Thank you.
Thanks, Marty, and thank you again, Ricardo. We'll now start our Q&A session, and I've certainly got a lot of comments to ask, so we'll see what sorts of comments come from the others as well. So the first question that came through is about helicopter money. And the question just being, and it'll go to both of you, so I'll ask Ricardo first and then go across to Marty. Do either of you actually see a way in which helicopter drops could be done, and still preserve a good measure of central bank credibility and central bank independence? So I'll go to you first, Ricardo. What do you think about helicopter drops?
I mean, helicopter drops mean different things to different people. But let me, so I could spend a lot of time just defining what a helicopter drop is. But briefly, I mean, a helicopter drop to be effective is ultimately a fiscal operation that transfers resources to someone, but where that fiscal operation is temporarily, but for it to be a true helicopter drop, permanently financed by money creation, and as a result leads eventually to some inflation. is this in a scenario where I agree very much with Marty, in which fiscal policy ends up having a certain predominance, if you want, is this there for potentially a good policy? Yes, meaning it's potentially something that would have some effect. At the same time, and I think, Bob, you really asked the question in a very precise and correct way, which is, but can you do helicopter drop credibly while preserving central bank independence? That I think is very hard because it's an explicit fiscal measure by a central bank. It's one that, because it is so unprecedented, will surely have an effect on currency demand in ways that the Lucas critique will for sure bite you. And so whatever you estimate of how much helicopter drop you do, for sure your estimates are wrong ex ante, and they're going to be different. So you may end up with too much, too little, and so on inflation. So I would rather have a focus on, here I agree with Marty, on fiscal policy as we know it, but let's refine it in terms of automatic stabilizers, do proper fiscal policy, instead of resorting to such a different policy that I really, really worry about the Lucas critique.
So before I go across to Marty, I just want to throw something in there, which is, of course, the helicopter drop. When we talk about it as money, well, in the end, we can't say for sure it'll be money as opposed to reserves or settlement balances as we have in Canada. And at some point, if there's an interest that's paid on those settlement balances, then it's not quite the same thing as just a printing of money. So I'll put that observation in there, but I'm going to throw it across to you now, Marty.
Well, no, I'm going to agree with both Ricardo and you. And that is to say, I think we can play games with different, hiding fiscal policy and the central bank cooperating with fiscal policy. I think, helicopter drops is a form of that. And the most extreme example is what you're saying is if you're going to pay interest on that stuff, if you're going to start to raise interest rates when we come out of a recession, the pressures that I talked about from the politicians will just be exacerbated. So I don't see that there's any way to avoid discussions with the fiscal authorities about our joint policy.
All right, so I'm now going to go to a question from Angelo Molino, and I'm going to read this verbatim from what he typed, so I don't want anyone to think that there's any Bank of Canada input into this question. So Angelo Molino of the University of Toronto wrote, rumor has it that the bank has been encouraging the fiscal authorities to put in place automatic stabilizers that would kick in at the ELB. Politicians and their advisors have resisted because they want to be able to take credit for the fiscal response during a crisis. How can we get the needed automatic stabilizers while still satisfying the needs of politicians? I'll switch the order this time around. Marty, do you have any comments on that?
I'm not a politician, and there are a lot of people in this audience, no doubt, have better ideas than me. I don't know what the Bank of Canada is doing, with the politicians. We do have automatic stabilizers. It is a large change. It would take a lot of discussion. I'm heartened by the fact that anybody's taking the idea seriously, and it's just I welcome any input into how to push the ball forward.
Ricardo, do you have anything to add?
I would add just to if you want, even just to the word automatic. I mean, obviously, if they were truly automatic, we would have had them already. Insofar as we're going to have to expand them or change them in some way, and we will change them for the near future, then the politician can take the credit for having changed the automatic status. There's an element in which now that we're exposed, a difference between a rule and a discretion exposed becomes a little more mute. So I don't think this credit will be necessarily all that binding as a constraint. I think, yeah.
Yeah, I mean, for this recession, it's too late, but hopefully for future recessions, we can, nothing is forever and there's always discretion in the end, but the more we can get it in law, the better.
I mean, I would add even more thing, Sharon, which is that, the classic automatic stabilizers are really things like the progressive income tax or unemployment insurance, which were really designed for as social insurance mechanisms, but which happen to become more or less generous with booms and recessions. And so in some ways, the automatic stabilizing macro side of it was I don't want to call it a side effect, but they're actually very important to start with, but they were associated with other things. Likewise, I think more importantly, I would have than even Marty's particular suggestion is the frame of mind, is that as we're thinking of, hey, maybe we want more progressive taxes or not to fight inequality. Maybe we want change in the fiscal system because of climate change or not. In all of those, I would say let's go back to the 1940s when people were thinking of those very smartly they were discussing, and there's wonderful articles in the American Review in the 1940s of it, by the way, where they were saying, as we're discussing these different changes in the tax and contribution system, let's think about their macro implications. Let's call the macro guys for the public economics conferences, and then you'll see that some of these actually either stabilize or destabilize the macroeconomy. And then you can really, as long as you infuse that macro consideration in all the discussions, that will make a big difference. I think, going back to something Marky said, in the sense the macro nowadays happens along the monetary policy. When it comes to the fiscal policy, macro is often in the second or third row, and it's really about the public social insurance considerations. But these really interact, and that's the lesson of these models, as well as of what we need for the policy. They really interact with the macro stabilization, and I think it's putting that back into the concern. That would be my priority if I was to, in a conference with the fiscal policymakers right now.
So next I'm going to link the discussion we've had a little bit back to the actual frameworks. So Marty, you mentioned that in a pandemic, good policy comes with large fiscal costs. And as you noted, the decline in both supply and demand that we've seen with COVID would likely lead to a large and persistent recession. In that environment, the decline in supply will cushion a little the disinflationary impact of the crisis. But we're also in a world that's low for long. So I'm going to pull all this together and combine it with your ideas of explicit agreements linking fiscal and monetary policy, perhaps with unemployment goals. It seems like that means that you would be suggesting right now a dual mandate that explicitly puts some weight on the real side of the economy is the way to go. Am I correctly summarizing one way of interpreting your comments?
Well, it's a very interesting question. I often think that the mandate is something that the political process gives us. It reflects society's values and how the politicians choose to articulate them. I think as a practical matter, if the bank says it's committed to 2%, but under certain circumstances, when we no longer feel that we can effectively do our job, that will inevitably be associated with periods of recession that call for an expansion. It will be observationally equivalent to that. But I think from the bank's perspective, I would be more comfortable saying we are 2% folks, but we don't think we can lift that ball on our own. We need some help from the other side of the aisle.
Okay, thank you. So Ricardo, I have a similar but yet different question for you. Because you spoke a lot about the increased interactions between monetary, fiscal, and macroprudential policies that is our new world over the past 10 plus years. And I wonder does that mean that now is definitely not the time to move off of inflation targeting? And in particular, would dual mandate policies be seen as de-emphasizing inflation? And then in terms of what you see as a three equilibrium right now, increase the risk of either ending up on the higher inflation equilibrium or on the disinflationary equilibrium?
That's a spot-on question, and that was the dilemma that I tried to put in my last slide, which is, on the one hand, let me restate, if you want, kind of the message from my presentation, which is, like Marty said, very consistent with his, which is, right now we have low interest rates, a QE balance sheet with short-term liability and long-term assets, and a large balance sheet and a relatively large balance sheet. Three main tools of the central bank. Looking forward, over the next 5 years, given what I describe as the state of the world, I see it as essentially infeasible for an independent Bank of Canada or Fed or Bank of England to raise interest rates, shrink the balance sheet, or refuse to give lender of last resort or unwind QE. As a result, there's a sense in which there is no tool to stop inflation from rising. There's the contraction of monetary policy is simply not happening because of the interactions that I said happen with the fiscal policy and financial policy. In that circumstance, Sharon, then we ask, then what keeps inflation from rising? Or can we really think about it? If I just said that the Bank of Canada will not have its tools because of their large interactions, or should not use its tools, even more than not have them, in order to stop any runaway inflation, then should we just say this to the public and say, look, inflation may be 5, maybe 6. It's just the fiscal goals and the financial constraints are such that we can't do it. And I said, well, what I try to say as a dilemma is maybe it's the other way around. And this is where I brought my work on attention and behavioral theories and others. I said, maybe not. Maybe we're just in a good equilibrium where people are not paying attention. They believe inflation is 2. Inflation turns out to be 2. And without admitting that the bank is now incapable of stopping inflation from rising, we'll just stay there. And maybe that's like you said, not the time to change the mandate. Let's stay with the 2% mandate and stay there. It is a gamble because, like I said, there's another equilibrium where inflation could run away, or like Marty said, there's upside and downside. Inflation could run up or inflation could run down. And I just see it as the bank right now, simply its average inflation target, its mandate, its inflation targeting independency mandate is consistent with staying in the 2% equilibrium, but does nothing to guarantee that equilibrium as opposed to the others. So that would be my answer.
Thank you. And with that, we are at 3:05 right now, so I'm going to call an end to this session. Thank you once again to our presenters and participants for this first afternoon session. We'll now take a short break and resume at 3:15 p.m. Eastern Time. Thank you.
Thank you.
Analysis and Research in the Financial Markets Department of the Bank of Canada, and I will be introducing and chairing this session titled Alternative Monetary Policy Tools, Lessons and Questions from the COVID Crisis. This session examines potential lessons from the current COVID crisis for the effectiveness of different monetary policy tools, such as quantitative easing, as well as potential side effects and limits of those tools. Joining us as discussions for Session 3 will be Ed Devlin, Annette Vissing-Jorgensen, and Emil Kashyap. Ed Devlin was Managing Director and Head of Canadian Portfolio Management at PIMCO. He has been frequently quoted as an expert on Canadian fixed income markets in leading media outlets. Annette Vissing-Jorgensen is the Arnold A. Rayner Chair of Finance and Management at the University of California, Berkeley Haas School of Business. She has written influential and widely cited work on monetary policy and large-scale asset purchases. Emil Kashyap is the Stevens Distinguished Service Professor of Economics and Finance at the University of Chicago Booth School of Business. He has widely cited and well-published work on the monetary policy transmission mechanism and banking. All three of our speakers are experts and thought leaders on the topic of this session, and we look forward to hearing their thoughts. For each discussion, we have allotted 20 minutes, followed by 25 minutes for questions at the very end. We encourage questions from the audience during the presentation. Please send your questions using the chat function on the right-hand side of your screen at any time during the presentation. And please remember when sending your question to direct it to all participants in the drop-down panel. Questions will be compiled and asked after all three discussants have presented. My colleagues are adding these instructions in the chat box now. Now, I'd like to turn things over to Ed Devlin, former Head of Canadian Portfolio Management at PIMCO. To remind you, we have allotted 20 minutes to your presentation, and I will give you a polite reminder when there is 5 minutes left. The floor is yours, Ed.
Thank you very much, Jonathan. I want to thank Carolyn and the Bank of Canada and everyone for the invitation. I've found this incredibly interesting, and it's as a citizen, it's great to see just how much analysis and thought goes into the policy making in trying to make sure we get it right for all our fellow citizens. So thank you. In terms of maybe just before I head into my presentation, just some thoughts. I think the previous presentations have been fascinating, but in terms of the decision in front of us in terms of what is the best monetary policy framework, my vote would be to stay with the current flexible inflation targeting framework, and within that, I think the key thing here was we were discussing, various ins and outs of the models, but the key thing here is, we do have a flexible target between 1% to 3%, and given we have been between 1 and 2 for the last, quite a few years, going between 2 and 3 would probably be a really good place to start in terms of getting our inflation rate, and then maybe after that we can talk about whether a more dramatic change is required. Kevin, if you could flip to slide 2, please. In terms of just trying to frame the assessment of the tools, I thought maybe the first thing to do was figure out, what are the objectives? Second, what have we learned so far this year? And I'm sure there'll be much more lessons, to be had. There are always unintended consequences, and unfortunately, with most of the policy tools we've used so far, most of them are negative. But let's explore those. What are the limits of these tools? Are there any tools left? There are. If things get worse, what are the exit strategies? And then maybe a couple of concluding remarks. Next slide, Kevin. So what are the objectives of the new tools? First, initially with the Bank of Canada, the goal was market functioning, where market participants determined the prices while the Bank of Canada facilitated liquidity. I thought that was a very good starting objective, and they did a very good job of accomplishing that. So that was met. We then moved, as the crisis wore on, to an explicit objective of decreasing risk premiums to ease financial conditions, which in turn should improve economic growth, which is the goal of our QE and credit easing policies. And again, as a lot of the charts were shown today, we've achieved those objectives. Term premiums are down, credit spreads are down. That does work quite well. In terms of bigger picture, how have these tools helped the bank achieve its consumer price inflation target of 2%? I would argue that these are very, very indirect tools, and it's very nebulous. Thankfully, expectations are anchored, but I would say definitely the jury is out on that. And lastly, financial stability. In terms of financial stability, I think here, investors might be, investors and I think the public might be a bit confused about financial stability as an objective. Are we talking about the housing market? Are we talking about the stock market? Are we talking about banking? You could make an argument both ways. You could argue that the extraordinary tools have inflated the stock market, have inflated the housing market and made it worse, and eventually will compress net interest margins at banks and make them less profitable in the long term. Conversely, you can say we bailed out all three markets and it's helped. So, I don't think we know at this point. And I think one thing that's key for any of these new tools being implemented is, clear public communication is key. And I think in the financial stability arena, I think there's, some work to be chopped there. Next slide, please. So, what have we learned so far in terms of the crisis or the pandemic, I should say? That initial conditions matter a lot. There were some presentations earlier today on that. I thought Marty did had a great insight when he said, markets are making relative judgments. Canada is not an island. Fortunately, I think for both Canada and the U.S., we benefited from positive initial conditions in terms of we had the policy rates that were substantially above zero, so they could be cut. Inflation relatively close to target, output gaps that were pretty modest in terms of being negative. The Bank of Canada clearly has a ton of credibility and clearly had the independence to use their central bank, to use their balance sheet, and that all I think went fabulously well. Also, as the Fed paper once said, when at the lower bound, go big and go fast. And I think the Bank of Canada was effective at doing that as well. And my assessment is that the markets clearly agree with the philosophy that both the Bank of Canada and the Feds will do whatever it takes to get through this short-term COVID, as per the massive deficits that we've been able to run and to facilitate society through this massive pandemic and disruption. One thing to watch, and I think is a key thing to watch kind of going forward, is the investors know never to fight the central bank. So the key things for the bank to watch is that investors will start to express their long-term views. They no longer can do it in the bond market, so they're going to start to express their views on effectiveness of policy, especially relative to across borders in markets where the central banks are not currently active, like foreign exchange, equities, commodities. So that's something to look at as we move forward. That how does the bank think it's doing? Well, let's look at the other markets, not the markets that they're dominating, to see if their investors have confidence or not. Next slide, please, Kevin. In terms of unintended consequences, unfortunately, the X there means most of them have been negative. One of the more substantial unintended consequences is that it's been relatively easy to fund large companies directly through the bond market and the stock market. Hard to fund small ones. And if this is left uncorrected, I should say, this could permanently change competitive landscapes. And this is something that clearly needs to be something to be addressed in the short term, going forward. As I talked a little bit earlier about financial stability risk, excessive risk taking, moral hazard, don't worry, we've got a central bank put. All of that is clearly in play. This is back to I'm having deja vu to 2008 and 2009, when these were the trades that investors put on that were the most successful, and they're doing it again. In terms of the unintended consequence of rising income equality, that really comes from mainly that financial assets are being inflated. Stocks are going up, bonds are going up, housing's going up, and so those that don't have those are being left behind. But the one thing, and we'll probably talk about this later in terms of central bank. I think Marty and Ricardo hit on this, that going forward, cooperation at some level, in some way, between the monetary authority and the fiscal agents has to, happen. And it's just a matter of what is the smartest way of making that happen. But as we think about how to address income inequality, makes me think of Milton Friedman, who doesn't seem to get quoted much these days. Keynes seems to be more in favor. And Milton Friedman once said, to paraphrase, in pursuit of economic equality at the expense of economic freedom is to achieve neither. But if you focus on economic freedom, instead of economic equality, you'll probably achieve both objectives to a great degree. So I think that's something that we should all think about. In terms of unintended consequences, misallocation of capital, as these big balance sheets are being deployed into the marketplace, you've got policy replacing the profit motive. So no longer bondholders. It's hard for bondholders to make a ton of profit these days. And same with stocks and others. So the idea here that this could lead to a misallocation of capital, lower productivity, lower economic growth, which is a bad macro outcomes. Another thing is governance issues. What about when the central bank is the owner of debt of private sector? We're not in the equities yet. The Bank of Japan is. What are the incentives for management? And I think that's something to think about. In terms of there's definitely and clearly going to be, if we keep in this low rate environment for a sustained period of time, diminishing negative effects on asset management industry. Diminishing returns lead to lower fees lead to less compensation and less human capital, which means you have less human capital allocated to critical investment decisions. And of course, as we lower interest rates, we increase the net present value of liabilities, which causes pension plans to be more underfunded and more precautionary savings from pensioners, which all leads to an increase in the savings glut, as Ben Bernanke once said. Kevin, the next page, please. So here's a slide that you probably won't see at most central bank conferences, but it's kind of my warning that I just wanted to put out there as something that probably is not in the short term, but it's going to happen. It's going to happen at some point. And I just wanted to kind of put that out there, which is, passive corporate credit funds. These are vehicles, ETFs, or investment. ETFs are mutual funds that passively lend money to corporations. I think is a defective product. And why? Because what you're doing is lending without any assessment of the borrower's ability to repay back, which is imprudent / reckless. Now, the one thing about people would say, well, bonds are senior to stocks, so why if passive can work in the stock market, why not the bond market? And I think there's a couple of important differences. Companies only have one stock price, but they can have hundreds of bonds that have a lot of complex features in them, and from subordination and options, et cetera. When borrowers go bankrupt, as Ricardo pointed out, is on the horizon if his forecasts are correct. They have to be liquidated or restructured. Passive funds just are not designed to do this. They don't have the skill set. So as corporate debt goes from being investment grade to high yield to bankrupt, the debt will move in and out of various market indices. And every time it does that, we potentially are causing multiple market disruptions. Active investors, as I used to be, will actively try to capitalize on forced selling by passive investors, amplifying, again, market disruptions at each point. Typically, when you have a defective product, historically, when a crisis happens or a big dislocation happens, we discover it, we get rid of it. If you think of Canadian non-bank ABCP or U.S. non-agency mortgages or portfolio insurance back in '87, they've all gone away because we figured out that, they were not prudent products. But during this particular COVID downturn in 2020, central banks, have been, supporting corporate bond markets. And in doing this, it may be bailing out defective passive products, which may allow them to proliferate, and in which case it could be setting the stage for a much larger crisis in the future. Kevin, if you do the next slide, please. And these slides here are just some charts about just how big is this current situation. Well, currently we're talking about this is passive corporate debt in the Eurozone, in euros and in US dollars. And it's about $350 billion already. And, if policymakers don't, put this on their radar screen and this growth is continuing, at some point we will have the bankruptcies that Ricardo talked about. And at some point, the problem I'm highlighting right now is going to happen. And it's going to cause a lot of disruption and loss of economic value to a lot of investors along the way. So that's, I hate to be the bearer of bad news, but this is just something that's, call it an early warning. I don't think it's an imminent warning, but it is something that it could be a significant negative unintended consequence of the large-scale asset purchases that are going on around the world. Next slide, Kevin, please. What are the limits of these tools? Yeah, again, it seems like trying to raise CPI by buying bonds is a pretty indirect link. And, I think you can see that when you just look at the velocity of money. When you see, policies that put money in the hands of the consumers, we get consumption, we get inflation. But when you put money to work into financial assets, you don't get the same direct link to CPI. As a number of the previous presenters have talked about, existing tools, as interest rates have gone a lot lower and credit spreads and term structures of interest rates have gone a lot lower, the ability for, traditional monetary policy or even the new tools to raise business and consumer confidence gets diminished. And in some times, and when I was in Europe not too many years ago, when you start to see low interest rates, it can either be because the central bank is doing its job and it can install confidence, but it also could be a sign that the central bank isn't going to be successful and the market starts saying, we're going into a really bad place, and that's why interest rates go lower. So, the old saying, are people laughing with you or laughing at you? Sometimes it's hard to tell, but definitely, you're starting to get to points here where some of these tools are, are getting to the point where unintended negative consequences could be outweighing benefits. And if you look at Japan, which has been brought up a few times today already, and I spent many years there in the 90s, it's particularly true. What you're seeing is a very toxic combination of low rates have caused, along with demographics where people getting a lot older, increases in longevity, people getting concerned about the social safety nets being there, is increasing precautionary savings at a pretty significant way. And I think we should always be taking a look at Japan when we, in some ways, as a forward indicator of places where we may end up if we don't put other policies in place to prevent from getting there. Kevin, can you go to the next page, please?
Just a heads up, you have about 5 minutes left, Ed.
Perfect. I think I've got 2 slides. So what tools are left? As the monetary toolkit is getting a little light, I think some of the choices are getting between bad and worse. So I would agree with Marty on the first 2 that, refining forward guidance or just doing a lot more of what we've done already is, it's not going to get you a lot. It's all priced into the market as we speak. Could we expand our credit easing programs by going lower in quality and bigger in size? Yes, but I think, again, we're replacing the profit motive there with public policy. We can do, I like repo operations and second loss type structures where there's still some market discipline and less moral hazard to outright purchases. And eventually, I think, the last bullet point here is really probably where we need to go to is some level of cooperation between the central bank and the fiscal agents. And again, I think a lot of the negative issues associated with that have been discussed, but that is probably of all the tools here, probably the one that's going to have the best chance of increasing consumer price. In inflation. Next chart, please. So in terms of exit strategies, there really is only 3 ways out of a debt trap. And so you can grow your way out, which is the best way, inflate your way out, which is second best, and defaulting is really bad. But, normally we wouldn't do that in your locally denominated debt. So, I think Ricardo's financial repression is really just a combination of the first 2. I think one thing that's being talked about in the market is how about permanent, this is the money drop, but the permanent financing of deficits is a 4th way out, kind of the MMT or modern monetary theory. I'm kind of more in the camp that this is more of a bridge to one of the first 3. It's not the 4th way out. But the bridge could be a very long bridge, and is a bridge to a good outcome or a bad outcome is very unclear. Some of the things that we should talk about too is I think we brought up central bank independence. Are we fighting the last war? As Ben Bernanke would say, when you're looking at these new tools, you have to look between the costs, the benefits, and the risks. And, all of them are diminishing at this point in time. So, I think that, again, when looking at some of these tools, it's better to be direct than indirect. And again, quoting Milton Friedman, inflation is always a monetary phenomenon. And we should think about that when we're thinking about things going forward. So just to conclude, the last slide. So far, I think the bank and a lot of central banks have been very successful in achieving the short-term objectives. It's been a painful process, a painful time, but the banks have done a great job. But paradoxically, unfortunately, the immediate crisis response may actually have been the easy part. The hard part may be trying to achieve long-term inflation targets with sustainable economic growth, with far worse and far poorer and unproven monetary tools. So back to the original suggestion by the Fed, when in doubt, go big and go fast. And at that, I'll end my comments.
Thank you, Ed. We will now turn the floor over to our next presenter, Annette Dissing-Jorgensen from the University of California, Berkeley Haas School of Business. To remind you, we have allotted 20 minutes for your presentation, and we will give you a polite reminder when there are about 5 minutes left. Over to you. Thanks.
Thank you very much. Can you see and hear me and see my slides? All right. So thanks very much for the invitation to speak, and Ed, very good talk. I'm going to compliment a lot of what you said. I'd like to talk about the bond markets during COVID and the Fed's response, and I'm basically going to show you a ton of graphs to go through 3 things. What happened in what are the sort of dislocations in prices, what happened, who was selling, who were buying, and why, in order for us to have a discussion of potential reforms and appropriate policy. And then finally, I'm going to go through the actual Fed actions, which I've listed here, and I'll get into in more detail as we go along. So first, just a few pictures to set the stage here. The blue line here is a 10-year Treasury. Notice how from around March 9, you see Treasury yields going up despite the S&P 500 going down. This is highly unusual, of course, and this did not happen during the financial crisis. Treasury yields were up 64 basis points from the 9 to the 18. Now, these dislocations were mostly in longer yields. The blue line here is a 30-year. You can see it's moving a huge amount, 80 basis points, red and green, the 20 and the 10 years, also moving a lot, whereas the yellow line, the 2-year, not moving that much. In terms of the underlying economics of this, the blue line is the nominal 10-year. The red here is the tips. Notice how the real yield is spiking much more than the nominal, corresponding to the green line, which is inflation swaps, a market measure of expected inflation, is going down. And so what's going on here is basically the nominal interest rate is a kind of complicated mix of very strongly increasing real rates and decreasing inflation rates. Since we have our own currency, there's not much going on with the CDS. Sorry about the Bloomberg screen here. It's basically stuck around 20-some basis points. All right. Now, the other market, because of huge dislocations, were in investment-grade bond markets. It's a different. The blue line is the yield spread of corporate to treasury for the investment-grade segment. The red line is the credit default swap, a measure of default risk, and they're supposed to be close, right? The yield spread is supposed to capture credit risk, but there's a huge spread peaking at over 300 basis points on March 23rd, and that spread is actually bigger than, again, it was during the financial crisis. This is in contrast to high-yield corporate bonds, where you see the yield spread, the blue line, moving much closer to the credit default swap in red. Now, MBS markets also saw pretty large dislocations. The red line here is a measure of the risk premium in MBS. That's called the option-adjusted spread. You see it spiking around the same time. So what happened? Who were selling? I'm going to show you a bunch of data on this, and I'm going to try to convince you that there were massive outflows from bond mutual funds and that likely affected both treasury and corporate yields. There's also a debate about the role of hedge funds selling treasuries to unwind something called the basis trade. I'm more skeptical that played a big deal, but we'll talk through the facts. And let me just note up front that I'm talking about who's selling. There's other papers who focus on who are not buying. There's a couple of very good papers by Duffy, who proposes central clearing of treasuries to overcome dealer balance sheet constraints. There's another very nice paper by He, Nagel, and Song, who model theoretically and document empirically dealer balance sheet constraints. Here I'm going to focus on who was selling, not on on dealers not buying enough. Here is, at the top, quarterly flows to U.S. mutual funds going back to 1990. There's massive outflows in the first quarter of 2020, over $300 billion flowing out. The top picture is mutual funds. The bottom is ETF. There's not that much exciting going on with ETF, so I'll focus on the mutual funds going forward. But $300 billion out. And importantly, this is out of the flows table from the financial accounts, so that it captures actual changes in ownership as opposed to just revaluations. Now, where this came from was an 8 sigma increase in the outflows from bond funds here at the top. Bond funds lost $265 billion in March 2020, whereas stock funds had more modest outflows. Within the bond funds, here weekly flows. The largest outflow was the week ending March 18, with more than $100 billion flowing out. A bit smaller the following week. Notice that this timing lines up exactly with when the treasury market and the investment grade markets were dislocated. Within the bond funds, in red here, you see outflows from investment grade funds that were very large. Notice by contrast, the orange line, there were only very small outflows from government funds, which include MBS in this data. The blue line is high yield. There were also outflows from those, as well as other risky funds, the global funds, and the muni funds. All right, so my interpretation of this is that the funds that faced outflows sold treasuries and other liquid assets to meet outflows that contributed to the yields spike in treasuries, but they didn't have enough liquid assets, didn't have enough treasuries, so they had to also sell a bunch of illiquid assets into an already falling market, and that contributed to these very large dislocations in the investment grade market especially. Now, to support that claim, there's a nice paper by Ma, Sharon, and Zhang, where they calculate out that the outflows in March were about 12% of assets under management, whereas the typical corporate bond fund had liquid assets of less than 4% pre-COVID. That's for both investment grade and high yield funds. They argue then and write a nice model that basically says that when investors redeem fund shares, then there's a pecking order of liquidation where they first sell liquid assets and then illiquid assets, effectively turning investors' flight to liquidity into a whole bunch of selling from the fund. To complement that paper by Ma and co-authors, there's another new paper by Farad Goldstein and Hotaksu that specifically warn also about these corporate bond structures. So corporate bond funds ownership share of the corporate market is up from 20% to about 40% in just a decade. And they argue that that's a really fragile structure. They promise daily, or in the case of ETFs, even better liquidity while holding illiquid assets. And that's an argument that Goldstein has worked on before. In the current paper, they documented in the COVID crisis, why did people sell? They document it's a mix of fundamentals and then essentially mutual fund issues. There's more selling from COVID-affected sectors, but there's also more selling of funds with more illiquid assets, or who hold assets similar to other funds. They have a brief discussion of a possible policy response to this, something called swing pricing, where there's a penalty for withdrawing when everyone else is withdrawing to essentially stop any kind of run dynamics that was introduced. They're arguing, they mentioned in November 2018 in the US, but has not been implemented, but it actually has been implemented in Europe and elsewhere in some places. Now, why do we see so large distortions for investment grade debt compared to high yield? I think one possibility is what I would call a disappearing safety effect. So Armin Krishnamurti and I have in earlier work argued, especially for treasuries, but also for investment grade bonds, that there is a safety premium on bonds with near zero default risk. So this is a simple picture graphing the price of a bond against the default probability. The dotted, the red dashed line would indicate a normal downward sloping relation. The blue line indicates that our argument that there's some investors who just don't want to think about the information cost of becoming informed. They're willing to pay extra for really low risk bonds. And therefore, you can think of perhaps the current dislocations in the corporate market as a slide down the blue line going from investment grade being really low credit risk to being more close to sort of a cutoff of high yield. You can see along that blue line, you're going to get a steep slope. So I argued in March that based on all of this stuff, much of which were sort of apparent at the time, that the Fed should go ahead and buy corporate bonds. They did that the next day, probably unrelated to what I sent them. And the argument even then was basically the same as the one I've given now. It's a severe crisis. It's a corporate crisis. There's a lot of corporate bonds out there. Half of it is rated just above junk. That was before COVID. And there was these large outflows. So here's just a quick graph for it from Deutsche Bank. The gray and the yellow show bonds that are close to becoming junk. And notice that that's where we have seen all the growth since the financial crisis. So that was one aspect of who was selling. I want to take some time to talk you through the other one that comes up a lot, which is hedge fund treasury selling potentially. So I'm going to start up here with the U.S. financial accounts, again, using the flows tables as opposed to the levels table. So mutual funds are selling a lot, 182 billion in Q1. The household sector includes hedge funds, and it's selling 249, and the rest of the world selling 233. Now, who's buying? Not surprisingly, money market funds and the Fed buying more than $1 trillion already. All right, so let's talk about these other categories, not the mutual funds, but the households, including hedge funds, and the rest of the world. Notice that the rest of the world selling of treasuries is really also very abnormal, and it's not something that we saw during the financial crisis. The households' holdings are more volatile, likely because of large moves in hedge fund positions. Now, just to convince you that we need to focus on hedge funds here, let me show you a few pictures that argues that both the household sales are mostly likely to be from hedge funds, but also the rest of the world sales are also likely to be from hedge funds, but foreign hedge funds. So here from the TIC data is the net purchase of treasuries by all foreigners. You can see very large outflows in Q1 as well as in Q2, which is included in here. If you split that up between official and private, in the bottom picture here, you can see that it's really mostly private outflows. And if you look at which countries were selling, the biggest seller was Cayman Islands, which is a big hedge fund hub. So that says we really need to think a lot about what the hedge funds were doing. And Shin and Trusco came out very early and said, look, this is all about unwinding of huge treasury basis trades by hedge funds. The way that the trade goes is that you enter short treasury's future position to deliver a treasury at a future date and get cash in return. And to support that, you buy a treasury security, so you have one to deliver, and you fund that using repo. Now, these trades, a lot of them are unwound in March because there was increased margin requirements and repo rates increased. The question is whether that led to selling or whether it just led to the hedge funds delivering early into the futures contract. So the paper by Hyun-Shin and co-authors graph to the left here the size of these levered fund futures position in treasuries. You can see they're really big, hundreds and hundreds of billions, and they do shrink in Q1. They also argue that this led to mispricing, with the cheapest to deliver treasury getting mispriced relative to repo rates, essentially. However, there's another paper, a very nice paper out of the OFR, that suggests that maybe this was not such a huge deal. They say, well, the funds do appear to have been selling, but actually these cheapest to deliver treasuries, if anything, were more expensive than other treasuries as illustrated by this graph. Now, this is then now, of course, a really big issue and somewhat confused. And I think that one argument I want to contribute to this is that closing out at treasury basis trades actually doesn't necessarily involve any selling, because you could do the sell route, which is option A, you sell the treasury, you get the cash in return to close the repo, and then you just enter an offsetting futures position so that you're basically having no net cash flows in the future. Alternatively, and this is what I want to emphasize, in the futures contract, if you're in the last contract month, you actually could just end the futures contract by delivering as promised, but early, and use the cash to close the repo. So at the bottom, the rules for U.S. For the CME treasury futures, the contract maturities, the contract months are March, June, September, and December, and the short seller, the short position, can decide to deliver any day of the last month. And it appears that that's what they did instead of selling. The CFTC has data on this, and they actually measure not only short and long positions, but they also measure what's called spreading positions, which is the extent to which the hedge funds have taken offsetting positions as they would in my option A, the selling options. You can see here in green that as you enter into March, if anything, these spreading positions go down because intuitively now you can deliver rather than trying to sell the underlying treasury. So I'm actually a bit more skeptical than a lot of people about the hedge funds having contributed a lot to this. That, of course, is important from a regulatory and financial stability perspective and how we treat hedge funds going forward. Finally, I want to talk about what the Fed did and whether it helped. This is, ex post, we're sitting here saying that central banks did a lot of good things. It actually is not as obvious as you might think that the central bank interactions did as much as people mentioned. In the graph here, I'm showing you in blue the S&P 500, and in red is the daily growth rate of new COVID cases. And you can see that on exactly the same day as the Fed did it, sort of whatever it takes moment on March 23rd, you see the growth rate in the virus falling. And then you see over time the market going up and up as the growth rate gets lower and lower. Also, the CARES Act fiscal stimulus, which was a huge package in the U.S., was on March 24. So we really need to dig into this to sort out whether the central bank's actions did a lot. So let me just recap what some of the actions were, and then I'm going to focus on just 3 days since there's a lot going on. Okay, so they started on March 3rd, lowered the target by 50 bips. Then on the 15th, they lowered the target again. They lowered the primary credit rate. They lowered the rate on the swap lines, but I'm going to focus here on the announcement of treasury purchases and MBS purchases. Okay, so our first day here to think about would be March 15. The announcement was at 5 p.m. Then, going forward, there was a whole bunch of things done in order to essentially stabilize short-term money markets. I'm going to be less focused on this because these, I've checked, have less of an impact on bond markets. Instead, we're going to talk a lot about March 23rd, that was the Fed's whatever it takes moment when they announced unlimited treasury and MBS purchases and corporate purchases, specifically investment-grade corporate purchases through two different facilities. The other date I want to focus on is the second corporate bond announcement date, April 9. That's when they increased the size of the program from $300 billion to $850, and they added some high yield, these fallen annuals that used to be investment grade on March 22nd, but had been downgraded. All right, so let's look at what happened. So let's start with treasuries. The graph here shows the 10-year treasury in blue. The three lines are the ones I talked about. Notice that the treasury market, the treasury yield keeps going up after the announcement on March 15. And while the yield does fall from the 15th to I guess that's a Sunday, from the 13th to the 16th, the stock market is also falling, so that may not be causal. Be that as it may, most importantly, the announcement fails to stop yields from increasing again on March 17 and 18. Then on March 23rd, the yield does fall, and based on intraday data, a bunch of that is causal. But what's interesting here is really the huge drop on March 20th. That's when the treasury yield for the treasury market really starts stabilizing. And that was not a day where the Fed did a whole bunch. There's one announcement at 10 a.m., but this is a gradual fall in the yield during the day. So does that mean that the Treasury market got stabilized without, for some other reason than the Fed? Well, actually, no. Because this is something that I think hasn't been emphasized enough in the press. The Fed started going all out and buying treasuries precisely on the 19th and the 20th when you see the market, the yields start falling. So that's a little bit unusual because normally we see, and the announcement does it, the yield moves, but here it's really show me what you got. The Fed going from purchases around 40 billion a day around March 16 to 70 billion per day. And so this is sort of supply and demand 101 with the Fed bringing down the Treasury yield. So what I take from this is that the Treasury selling were driven by liquidity needs, not the loss of confidence in the Treasuries as due to the inflation in CDS. A lot of that liquidity coming from mutual funds, both corporate funds and other funds selling, and the Treasuries being the most liquid thing they had to sell. The March 15 announcement was not enough to make others provide liquidity in the market in expectation of selling to the Fed, and it took actually large purchases to bring yields down. What's interesting here is this is very different from how the Treasury QE worked back during the financial crisis. So back then, remember on March 18, 2009, how the 10-year dropped 50 basis points in a couple of minutes after the QE1 announcement of large Treasury purchases? That was all an announcement effect. And so I think what was going on is that back then, there was no market dislocation in Treasuries. It was not about actually buying. It was more about longer-term factors such as signaling about the path of future interest rates, safety effect in Treasuries, and so forth. So these are my summarized lessons from the Treasury markets during COVID. Let's take a couple of minutes then to look at the corporate markets during COVID. So we'll focus on the 2 days, March 23rd and April 9. And I'll show you some graphs that both yields and CDS on investment grades fell sharply in both dates. That's also the case for high yield. And let me just show you some pictures here. This is intraday data based on ETFs. This one is for investment grade. I'm plotting you the return because the prices here don't make that much sense. Notice the huge increase, like an 8% return within hours on the March 23rd announcement, and also another 3% on the April 9 announcement when they expanded the magnitude of the purchases. Here, the high yields, they did particularly well following the April 9 announcement, but also, and encouragingly, did quite well right after the announcement on the 23rd, potentially suggesting some broader effects of those purchases. There's a very nice paper by Haddad, Moran, and Muir that show intraday CDS, and you see very well-identified reductions in corporate risk on these days. This is a rhetorical graph, just to wrap up this corporate bond stuff. These were completely different from the treasuries. The green line here, the purchases, and basically they haven't bought much, 12 billion, which is peanuts in this context by the end of July. And so what do I take from this? There were basically sort of a complete change in market confidence after the Fed announcement on that day. Here is, I think, an amazing picture of this is a VIX ETF. The VIX just plummeting right after the announcement. And you can see that also in the intraday data, very strong, basically VIX dropping by a huge amount on March 23rd. So
you have just under 5 minutes left.
Yeah, that's fine.
Thanks.
So what I take from all of this in terms of lessons from how monetary policy worked during COVID in the corporate market was that this is very different from the treasury market. So in the corporate market, we saw huge selling, especially in mutual funds, driven by concerns about corporate fundamentals, as well as issues related to mutual fund structure, as I discussed. The announcements by themselves were enough to calm markets. This really reminds me of the Draghi, whatever it takes, speech regarding the ECB's OMT. They also never bought anything under the OMT, yet it's thought to have been a huge event in monetary policy history. Notice, just to document sort of the whole shift in market views, how the investment grade flows now in daily data, the outflows sort of gradually diminish after March 23rd. And in panel B, for high yield, notice actually it's interesting, just before the April 9 announcement, notice how there's a pretty large outflow the day before. I suspect that the Fed was looking at this as part of its decision making. But completely different mechanisms here, more like preventing a run rather than providing liquidity. I'm going to skip the MBS markets. I posted my slides and instead just summarize by giving you my thoughts on whether the Fed purchase programs had real effects. And I think they likely did. So we saw that the corporate CDS fell. And, of course, it's possible that the companies could instead have restructured. But as Ed and I discussed, it seems unlikely that with 40% of the bonds held by these mutual funds with very few resources and, that this could have been done in a smooth fashion. We've seen very large corporate bonds and also treasury issuance after the market stabilized. The Fed presumably had something to do with that. And also we have prevented a financial crisis, right? We haven't seen the COVID crisis turn into a financial crisis. And also we've seen large wealth effect in the stock market. Let me just finish by showing you here this is the S&P 500 on those two key dates. You see very large moves up on both dates. There's some negative news about the CARES Act coming in later in the day on the 23rd that we probably shouldn't blame on the Fed. Finally, what are my remaining concerns? The Main Street lending program, consistent with what Ed said, it's hard to lend to small firms. The Main Street lending program has basically not lent anything. People argue that the terms are too stringent, although the Fed to some extent has been successful in lowering risk premia and constraints in the banking sector. So the lack of volume here is probably partly due to the good work by the Fed. I'm very worried about moral hazard, as Ed was. I'm also worried about a bunch of zombie firms. If we have all this borrowing going on, will we have a lag of creative destruction? And, we'll see going forward. Thank you very much.
Thank you, Annette. We will now turn the floor over to our next presenter, Anil Kashyap from the University of Chicago Booth School of Business. To remind you, we have allotted 20 minutes for your presentation, and we'll give you a polite reminder with about 5 minutes left. The floor is yours.
Okay, thanks, John and Carolyn for inviting me. Here's a little outline of what I'm going to do. The assignment was to actually reflect on these alternative monetary policy tools and kind of do a presentation like what Annette just did. I'm going to default on that because, I thought maybe others might do it, but also I think the judgment on all of this is still going to be out. And so I'm going to spend a chunk of time just talking about how I think alternative monetary policy tools work. And then I'll say a bit about the deployment. I will reiterate, I don't think we can draw a fine line yet, but I do think we've got these open questions, and there's going to be 3 of them that I want to stress that I think will be very, very important. And I should say my views here are just my own. I'm not representing the Bank of England today. So, Kevin, if you can go to the next slide. It's a little remarkable that essentially every central bank talks about the monetary transmission mechanism when they come to alternative monetary policy tools as being the same as usual. Ed explained why the links might be complicated, but the argument basically goes that you control aggregate demand. Aggregate demand affects an output gap. You take an output gap along with inflation expectations, and then you get inflation. So I call those 2 steps in the transmission. And if you can go to the next slide, I think the question about AMPs is mostly to do with the first step. I think we don't have enough experience with negative interest rates now to know whether they work differently. You might think that expectations matter there, and the public might freak out if they saw negative interest rates as a target in some countries. So that might have something to do with inflation expectations. But basically, it comes down to thinking about the first step. And I would argue there's 2 ways of thinking about that first step. The way that was that's kind of typical, I think they didn't spell out exactly how the totem model that was used in the first session works, but it sounds like it works something like this, which is there's an interest rate that determines the output gap. The ugly but important detail is there isn't really just one interest rate, and most of these new Keynesian models don't have a very sophisticated financial system. So you can add elements of a financial system, but you have to take a stand on at least three things to think about things in a new Keynesian perspective. You've got to decide, is it a safe or a risky rate? Is it a short-term or long-term rate? And is it a bank-determined rate or a market-determined rate? Now, I think everybody realizes models are abstractions, and it's probably elements of each of these things. But if you think about then what the relevant rate is, it's the combination there that I have in red, where you start with the short rate that you can control. You can use forward guidance, perhaps, to give something about the path. You could threaten to do QE or do QE to do something with the safe term premium. And then there's probably a borrower credit risk premium that's layered in, along with a lender risk premium under some theories of transmission. So when you think about AMPs, part of what I think about is which of these elements in red do you think are dislocated? Is it, something about one of the risk premia? Is it about the path and so on? Because it makes sense that different of these tools will influence different parts of the relevant rate. Since we're talking about the Canadian economy, I think you'd want to think also about the exchange rate. And as a couple people have said, maybe what you're going to get out of some of these things, as Marty was arguing in the last session, is you're mostly going to move the exchange rate because perhaps the relevant rate, whichever one you pick, is already very low to start with. In fact, that's a caricature of the concern about the AMP. The blunt way to put it is take the 10-year rate, use whatever combination of tools you want. You can drive that thing from 60, 90, 100 basis points down to zero, and after that, you're out of ammo. So that's one view of alternative monetary policies. A second view that, if you can go to the next slide, Kevin, is to be less structural about all this and just to say that, in fact, it's much more complicated. It's true that there is something like a relevant rate, but there are lots of channels that determine funding conditions, both for households and for businesses, and that what you really want to think about is something that I call financial conditions. And those financial conditions will affect aggregate demand and an output gap. But then you've got to be kind of careful about what goes into the financial conditions index. So at the very least, I think you'd have four ingredients. You'd probably have something to do with equity markets. You'd have something to do with bond markets. You'd probably have something to do with banking markets. And then finally, an exchange rate. Now, one thing that doesn't get so much attention is, to what extent can individual countries influence their financial conditions? So Marty was talking about the slope of the yield curve and what you could do there. I think it's also true that equity markets are integrated. Bond markets are somewhat integrated. And so it makes sense a priori to think that financial conditions would have a big global component. I'm going to review some empirical work that suggests that's true if you just do pretty simple things. So I'm going to deviate for a second and talk about some research that I did with Steve Cicchetti, Kathy Mann, Mike Ferroli, and Kim Schoenholtz. So if you can go to the next slide. We wrote a paper for the U.S. Monetary Policy Forum earlier this year that I think probably triggered my participation on this panel, where we tried to look at financial conditions. We took that second view that you need to look at all these different financial indicators, and our goal was to try to assess how unconventional or alternative monetary policy choices affected these different financial conditions components. So I've listed on this slide the U.S. version of the financial conditions index with what we measured. And then noted for some of these countries, we also included a sovereign spread for the countries that aren't anchor currencies. And we took these 56 series and said, let's look at how different monetary policy tools might impact the different financial conditions indexes in each of the countries. So the first finding on the next slide is that when you take all 56 of those series and you knock out the cyclical variation, you find that the global component, one factor explains 20% of the variation. Now, that one factor is a little bit of a mystery. We tried to see whether or not the Fed's policy choices could account for that factor. It doesn't look like that's very strong, but that's important. And for a country like Canada, which unfortunately we didn't have the time and the data to include Canada analysis, I'm sure that global factor would be pretty important. So if you turn to the next slide, you can see what's underlying this global factor. And what I've graphed here are the sums of the factor loadings on the different measures across the 56 variables. So the global financial conditions index is elevated, means that stress is higher, and all these signs are pretty intuitive. When equity volatility is high, that means loadings are positive on that variable. That contributes a lot. Equity prices being high means that conditions are loose, so that's why the big negative. One way to think about this is there's a lot more volatility in equity markets than in some of the other markets, and those volatilities are pretty highly correlated. But you can also see that interbank spreads and credit spreads get positive loading, so more stress means bigger weights in those variables. So I think this all kind of makes sense. This brings us then to trying to assess monetary policy, and if you can skip forward 2 slides, Kevin, I'll show you what we found. So down that left-hand column, you could see the 6 types of alternative policies that we looked at. It's easier said than done to separate out quantitative easing, which we refer to as expanding the balance sheet to, buy more risky securities, from maturity extension, which conceptually you could say is holding the size of the balance sheet fixed but lengthening the maturity. The others are more familiar: date contingent forward guidance, state contingent forward guidance. The monetary base, we just measured the size of the base relative to GDP and the negative rates. Okay, so what did we find having tried to do this? I think this was a good idea. The data, however, were not very strong in providing enough variation to unambiguously uncover a lot of effects. So how do we read this table? Well, the gray boxes there means that when you look at how a tool was deployed in a country and you try to correlate it with financial conditions, you get nothing. So insignificant. White means that a country didn't try it. So, for instance, Japan has not done date contingent forward guidance. The black minus signs are the expected sign. So negative means when you deploy the tool, you ease financial conditions. And the first takeaway from the chart is look at all the gray. Most of the time, there's no obvious correlation. When you do find correlations, the colors indicate the size of the t-statistics on the variables that on the proxies we were looking at. And yellow is 2 t-statistics bigger than 2. Orange is bigger than 1.5. The red pluses are kind of unintended consequences or misfires, where it looks like you deploy the tool and conditions tighten rather than easing. And so the second finding is not only do you see a lot of gray, but you see a lot of pluses, just about as many pluses as minuses. So these tools, it's very hard to come up with econometric evidence to tie them together. I think the way Annette was trying to do things, like with these event studies where you're going to very, very fine data, can be helpful. Of course, then you run into the problem she pointed out, which is you get these confounding events where many things are happening around the same time, and you have to worry about the persistence of these effects, like what happens if that's true, that market moves for a very short window, whether or not things reverse at a later date really depends on the assumptions associated with event studies holding up quite well. Turning to 2 further conclusions, it looks like most of the countries have at least one of these red pluses, so something that was tried didn't look like it worked terribly well. And then finally, one thing that I thought was pretty interesting is that the QE and the ME, if you look, lots of times you have opposite signs suggesting that things are collinear. That's not so surprising because most of the time those two things were announced around the same time, often in the same announcement. So I would say you can't really tell whether it's maturity extension or quantitative easing that works. Probably growing your balance sheet in one way or another could matter. But all this is just to say that the empirical evidence on how monetary policy or how these alternative monetary policy tools works, even before the COVID period, was really pretty shaky. Now, I'll encourage you to look at a paper that will be ready in a couple of weeks that my colleagues Elizabeth Kemp and Lubos Pastor are working on. They've been doing like a meta-analysis of everybody's attempts to identify the effects of alternative monetary policy. And some of the questions they're looking at is, does it matter where you sit as to what you find? So you could compare results that are published by people working at central banks and people not working at central banks to judge the effectiveness of monetary policy. And when their paper comes out, I think you'll be interested in seeing what they find on that front. I was hoping that it was going to be done by today so I could have showed you, but I can't front run their paper. Anyway, I think if you started out with a flat prior as to how well these tools would work, you wouldn't be moved terribly by the empirical evidence, because there are, some papers that find stronger findings, but there's a lot that are like this study that I referenced where you just don't see a whole lot. And maybe that's okay, because maybe it comes down to something as simple as risk on versus risk off. And when central banks, to use Ed's word, go big and go fast, people are willing to step into markets, and attributing exactly why and when they step in is hard. Maybe that does work, but the econometrics here are difficult. So partly because of this, I'm not going to try to go through what I would say the evidence is from the current episode. I'll just go to the next slide. They followed Ed's advice in terms of going big and going quickly. Just the size of the footprint that central banks took into markets was astronomical. I've got two scales here for the BOE and the Bank of Canada, because the balance sheets were smaller, but you could see that the movements were very, very large. And I think, we'll have to debate as to exactly how much this mattered. As Annette said, it's pretty complicated. If you go to the next slide, you could see why econometrics is going to be challenging. I call this alphabet soup. So this is the Canadian version. And I could have spent 20 minutes going through each program, but these were all rolled out around the same time and in different magnitudes. So I think the econometrics of figuring out the efficacy of these tools is going to be very, very, very challenging. So let me close on the last slide with what I think are the three big questions that we should be talking about. The first one goes back to issues regarding communications, accountability, just central bank transparency. One question is, why did it take so much to stabilize the markets, and what's the lesson that we learned from that? I guess one kind of sharper way to put this would be to ask yourself, if you had to go explain to somebody who wasn't a monetary economist why you're buying $200 billion of assets, and why you're buying bonds and not stocks, or one set of securities and not another, it's going to be challenging. And figuring out how you explain this to the public, how you describe what the transmission mechanism is, and what constitutes success is going to be a big issue for reasons I'll describe in just a second. But talking about this is so much more complicated than talking about changing the policy rate, or even if you were to do something like give forward guidance saying interest rates are going to be low until we think about thinking about it, that kind of thing. That's kind of understood by the public. It's not viewed as a step outside of the usual sandbox. Once you've done all this, you're going to have to invent some rules and principles after the fact, I think, to talk about how to use this again. Okay, that brings me to my second set of issues, and I would say, to put it bluntly, central bank puts. So one type of put is whether markets now think that the central bank has your back. I think if you were to survey market participants in the United States, I bet you more than 95% would answer the question, do you think that if we saw dislocations starting to emerge that look like what we saw in March, the central bank will step in and start buying things? Everybody thinks that. I don't know how the Fed's going to get out of that. I think in lots of countries that would be true as well. And that raises questions about, are you going to charge the people who are the winners in the trades that get bailed out anything for being on that side of the trade? Would you have to come up with some sort of a communication plan for what's the boundary as to which markets you stabilize, when you stabilize them, and so on? Those are complicated conversations. And again, I'm not sure econometrics is going to help us very much with the answers. But bailing out certain financial positions and letting people get rich on the back of it is going to create a political economy problem. The second central bank put that I worry about is vis-a-vis politicians. So once you've got a central bank's balance sheet and you've discovered that you can lever it, the chance for mischief is enormous. One of the whole points of the Dodd-Frank Act was to try to constrain the central bank's hands. I was not a fan of the way that they changed 13.3 in the United States, but I think that it was clear that Congress at that time thought, I think the chapter in Bernanke's book on this is bailouts, hell no. I never want to see that again. And what was the first thing that happened when we got to the CARES Act? Well, we decided we were going to give the Treasury $470 billion or whatever it was, $450 billion, and say, go out and provide an equity cushion so you can run the Fed like a hedge fund. Getting the politicians unaddicted to that is going to be a real challenge. If you want a concrete example, imagine Trump wins. What are the odds that he has MAGA bonds that he issues and says, well, the Fed can buy these to support the American dream. We're going to build roads. We're going to do this. We're going to do that. I mean, this is a real Pandora's box, and I think the central banks are going to have to come back with some sort of a answer. I endorse what Ricardo and Marty were talking about, that there's going to have to be a big conversation about the boundary between fiscal policy and monetary policy and the coordination, all of that. But that's a huge challenge. And then finally, the question I think is going to hit us very, very quickly. Some of these things are going to be medium term. I think the big one that's coming was it was plausible in March to say, okay, we see that we were heading towards this lockdown. The economy was fine in February. You don't want a bunch of businesses that were perfectly good and operating to be wiped out and have to reorganize all the capital that was associated with them and move the workers around. So we're going to provide a bridge. And when we get to the end of this, everybody can go back to normal. So people talked about putting the economy in the freezer and then unthawing it. Well, that's not going to happen now. It's pretty obvious that a lot of businesses are actually going to fail. And so, we had a strategy that said take companies and give them debt to get them through. We now have the machinery in place through some of these programs to keep adding more debt support on top of what's already been given, so you can put debt on top of debt. But I think businesses are going to resist taking on debt at some point. And the bigger problem is going to be, how do we restructure the debt that the official sector has put into the economy when the time comes? So maybe some of these businesses will be perfectly good if you could write down some of the debt and then go forward. But the official sector isn't really good at that kind of a restructuring. And it's also not very good at pulling the plug, especially on politically connected firms. So I think it's going to be very, very difficult. The representative problem I think about is take a small business. It's got a landlord that is got a long-term lease that, is owed money. They've got very little revenue. They may have one creditor. It's a bank. Maybe the central bank has guaranteed some of the debt that's been extended to keep them alive. How do you keep this firm, or what should you do with this firm? One answer is, well, you should just make them renegotiate with the landlord to write down that lease, free up the space, let somebody else come in there. The landlord may try to negotiate from a pretty tough position, but at some point the landlord's going to realize maybe I've got the best tenant I'm going to get. Maybe I need to share some of the losses. Certainly, putting guaranteed loans into the company that say, the government's going to guarantee these loans doesn't address that problem if it turns out that you need to allocate the losses before they're going to become cash flow positive. So I think that's a super challenging problem, and it's not an easy one to deal with. So let me leave you with that.
Thank you, Anil, and thank you to all three of the presenters. So we'll now move on to our Q&A session, and we'll go through as many of the questions as we can. First, let me ask a question from Graham Johnson, who is here at the Bank of Canada. So Graham's question goes to Ed Devlin. While appreciating asset prices can increase inequality in the sense that asset owners benefit more, it does increase the overall level of wealth in an economy. The fiscal authority could then use the tax system to redistribute more equitably this increase. Isn't this a better approach than having the central bank not take necessary actions because they may inflate asset prices? In the end, it does argue for further coordination or the need for coordination between monetary and fiscal authorities. But I'm just wondering what your view is on that circuit, if you will.
Sure. Great question. And I think that it is a necessary but not sufficient condition, right? So in terms of, I think the central banks coming in and buying debt and inflating asset prices was required. And then I think Graham's got a perfectly good, suggestion in terms of using the tax code to then redistribute the wealth, through society. I think that is fine. I think that, like I said before, let's make sure we don't fall. I think the thing I get concerned about when I hear about politicians is they focus, depending on what persuasion, is they focus so much on equality and don't think about, growing the pie and then redistributing a bigger pie. And so I think Graham's question gets to the heart of that, and I think that I've got no problem with that suggestion at all. And I think it's not. I think the central banks had to do what they did, so I don't have a problem with it.
Thank you. Next question is from Leanne Yang, who's at the University of Toronto. So this question is directed towards Annette, and it's a question about the moral hazard problem. So here's the situation. Is it possible that the large asset purchases by banks or governments could generate strategic excess selling by markets? For instance, if a fund holds many shares of assets and plans to sell in the long run, and if it expects that the bank will save the market once the price drops beyond a certain level, then the institution may want to sell some shares now to push the price down to that level so that the bank will inject the money.
So I'm not thinking that any particular institution has that much market power, especially because the decisions on when to sell in these funds, come down to the individual investors. So you need to coordinate a whole bunch of people to all do the same thing at the same time. And so it's not like saying, okay, the CEO of Vanguard, BlackRock, and State Street will get together and do this. It's a decision made by a whole bunch of different people. So I'm less worried about that.
Another question for you, Annette. This is coming from Anil Kashyap, University of Chicago booth. So if the party buying the treasuries had not been paying for them with reserves, do you think the effects would have been different?
Anil, are you saying that instead if they had just printed money, what are you saying?
Well, the alternative narrative is that some some people wanted literally cash-like securities to meet margin calls and all of that. So the thing that was special about the central banks intervening is they actually created reserves instead of just handing people selling one thing and buying another. So if there was a genuine cash deficit in the system, that's something the central banks can solve. It's a little different than most other problems. Very special problem.
I mean, to some extent, you could say it's kind of brilliant that right at the same time as the optimal maturity structure of the Treasury that changed from, 5 years and a bunch of maturities around that to overnight, ideally, like instantaneously, even within the day, the Fed was able to do that without, any sort of Treasury refunding or anything like this. And so in that sense, paying with reserves is probably even better than paying with cash or something else, because that's precisely what makes the whole, market structure liquidity work out better.
Thank you. So the next question I'm going to direct to all three of you. The pandemic may create structural changes in the economy. So, for instance, more teleworking and investment in healthcare, less travel, and fewer large gatherings. Could the use of tools delay those structural changes by creating zombie firms in industries that are less feasible? In that sort of with that as a background, how should central banks take this into account when they're designing and implementing some of their extended toolkit? So I'll start off on that one. Well, if someone's ready to go, I'll do it. Okay, Ed first.
So I think I kind of put this in a bullet point in one of my slides. I like, any kind of design of a product where the private sector takes the first loss. So whether that's through a repo instead of an outright purchase, or through a securitization vehicle where, the central bank provides liquidity in the senior financing, but the first losses are with the private sector. I think any of those kinds of incentive systems, when you're designing pools, will help restructure the economy away from the losers and towards the winners.
Thank you. Anil?
Can you let Annette go first?
Annette?
I lost my audio for a second.
Yeah, sure. So the other question was about whether some sectors are so far harmed that we just have to let them go. It touches on the last thing you were discussing.
Oh, okay, got it. Okay, so I didn't hear the first preamble. Yeah, I think this is why having these principles, like what Ed just said, that there's got to be skin in the game and that there's got to be risk. I mean, Powell, when he first rolled out the problems in the U.S., said over and over and over again, we can't make grants, we can make loans. And, debt doesn't solve a lot of these problems. I mean, it's totally unfair that people in very, very similar industries ended up getting such different outcomes. At one point I had this list, did you know it was good to sell liquor but not run a bar? Well, it turns out one of them gets a massive windfall, the other one doesn't. Or that if you work outside maintaining people's homes, it's fine, but if you go inside and you're the maid, you're totally out of luck. I mean, there's lots of capricious windfalls and losses that come out of this, but I'm not sure certainly that the central bank should be providing the social insurance for any of this. And I don't know whether we're going to change the rules of the game. I do think that the decision to support businesses rather than just giving direct support to individuals is going to be looked on rather differently if we move into a period of insolvencies, because then you'll just say, well, why were we funneling this through the firms? It all made sense when it was a liquidity shock, and now that it's a solvency shock, I think it's much more questionable. And I think there will be a point where we have to just say some of these businesses are just not going to be viable for a long time. And, there's a lot of restructuring that's going to happen. At the the last thing I would say is if we're going to put public money in, there's got to be some sort of a loss sharing scheme. So to go back to my example of the landlord, I don't see why the landlord gets a free pass where all the money gets pumped into the business. The landlord gets paid without having to take any write down. That doesn't seem right. Now, I don't think you should spend rent either, because, you know, that doesn't seem appropriate. But there's got to be some loss sharing to recognize the fact that nobody was anticipating this. It was bad luck, but, you know, there are losses there, and we can socialize them to some extent, but we're going to have these inequities, and I think the central bank should try to get away from being involved in this and put this back into fiscal policy.
I guess the parallel I would draw is to the Paycheck Protection Program, which I consider like a very poorly designed policy, precisely because it didn't condition any of these grants on whether the sector had been hit a lot or a little. If you look at the data, lots of the people, actually a huge fraction of the money was paid out to sectors that had actually very small losses. So from that, I take that it's not fiscally responsible to just like hand out money. You know, the whole idea that we had to do it in a hurry did not mean we couldn't say let's condition it on industry. So if you're gonna give away money or lend money, I think you have to do it to the people who are actually harmed. But that then causes the issue of at what point are they insolvent, and that's where nil slots come in. You know, at some point we just have to let them go. But certainly some kind of focused policy design seems necessary.
So a follow-up question that's related to that. When we think of funding for lending programs, they're seen as something that are inside central bank toolkits. But in this pandemic, we've also seen governments offer lending directly to businesses. And so the question is, are we better off having central bank programs or government-run loan programs? So I will start with Ed on that one.
I think you're always better with the government. I mean, they're the fiscal agent, so that's their job. And if they lose, you know, people's money, then they are accountable to the electorate. And I think the central bank should stay away from it as much as possible, but sometimes we get sucked in, as we all know.
Annette, any alternative views?
I don't have a lot to add to that.
Neil?
So, yeah, I should disclose I've been kibitzing with the people at the Fed about the design of the Main Street lending programs. They have an academic advisory panel that I'm part of. I think here's the way I would describe the Main Street program. The parameters have been designed by the Treasury so that the loss risk to the Treasury is pretty small. In fact, you saw the testimony that Eric Rosengren did a few weeks ago, and the follow-up letters from Congress to Secretary Mnuchin saying you should be taking more risk. I think it's hard once you start thinking about this to try to get somebody to actually make any loans that are going to make losses, because somebody has to go up and testify and say, what were you thinking when you made these loans? And so the Treasury has taken so far a pretty conservative view, I think, on the way that the loan terms are set. The advantage of that is that they're not going to have to testify on why the losses were made. But there is one potential way that this all could work out to be useful, where it winds up in the central bank, which is, suppose you end up with a classic credit crunch where we get a second wave of the virus coming back, the economy slows, there's lots of losses, and the banks end up taking so many losses that the banks themselves are broke, okay? And that you've got a credit crunch because actually loan supply from the banks is contracted. In that case, running a discount window like penalty lending rate, where the central bank is, underwriting some of this, but not taking much credit risk. So lending at a penalty relative to normal rates, but facilitating credit supply. The Main Street program would actually work in that scenario. Then all of a sudden you'd see viable businesses showing up saying, my bank's cut me off. They're willing to put a little bit of skin in the game and continue lending. Why can't we have a program? That program, I can understand a logic for. It wasn't probably what Congress had in mind when they tried to set this up. They didn't think the banks were going to be broke and loan capacity was going to be constrained. But if we went down that path, having a funding for lending scheme kind of makes sense in that world. But it's a pretty special set of conditions, and I think the politicians probably favor grants and and want to see the money going out the door. And then when the losses come, they probably want to beat up whoever made the loan. They don't want to be reminded that they were the ones that go make the loans. So I think it's something that's better if the central bank typically would not be involved in. But I think, you could imagine scenarios where there is funding pressure for the banks and you want to try to support credit supply. And you could imagine the central bank kind of doing that.
Okay, can I just add one thing to that? And that would be that, so I kind of slightly disagree with that in the sense of if the banking channel gets clogged because we have bad banks, then I think the right approach is back to some kind of securitization where the private sector chooses the winners and losers. And those winners, private sector would be the non-banks out there, and the central bank can provide the liquidity to create the scale.
I don't disagree with that, and I think getting the banks to issue equity and not letting banks operate as zombies and all that is what you'd want to be doing. But what might have to happen before you could get the securitization working is you'd have to crystallize the losses on the bank's balance sheets, and you might end up creating a pretty big credit crunch. I think it'll be difficult to securitize small business loans. If we could have done that during peacetime, during normal times, we would have already done it. So I'm not strongly in disagreement with that, but I do think that there are times where it's just, I think you had it on one of your slides. It's very easy to get money into securities markets to go to big firms. What do you do about small firms? And if you think you need the banks to be the intermediary for a little bit, I guess I'm not as optimistic that you could securitize that in a very big way. And it maybe even not for profits. The Main Street program is now going to include potentially hospitals and a lot of universities that historically haven't gone to banks and not clear whether they go to capital markets. I don't know if it's a great thing or not, but I think if you've got people that aren't used to operating in securities markets, doing securitization is hard and it takes a while. It'd be great if we could get to that at some point, but I'm not optimistic it could be done quickly.
So the next,
we should work on it now.
So the next question to everyone, I'll go to you first, Ed. How important is it for all market participants, instead of just primary dealers, to have access to the central bank alternative monetary policy tools such as repos? And in answering, is there a difference between when we're thinking of tools that are primarily market functioning versus tools that may be a broader general source of monetary policy support or stimulus?
So I'm not sure about the second piece. I don't think it's that. I think it's more the market functioning objective. I agree with that. And I think it is, I think 08 taught, I think any banking crisis around the world you look at has taught you that it's good for the central bank to be able to, go through a non-bank channel in strategic markets to provide liquidity when the pipes get gummed up in the banking market. And if I just use a Canadian example, and I've talked with the bank before about this, but, say provincial repos or strategic markets, like you want, local governments to be able to have their markets function. Sometimes, I think it's a good idea to have the capacity for, market participants to have access to the central bank's balance sheet. That doesn't necessarily mean they have to go through the commercial banks, especially in Canada when you're dealing with an oligopoly.
Thank you. So recognizing that this may be a little more of a Canada-specific question, Anil, do you have anything to add?
Yeah, actually, I think one of the questions the central banks are going to have to wrestle with is how do they get out of this put that the markets think they have. One way to do it, I'm not sure it'd be effective and I'm not sure it'd be credible, is to say, look, we are going to draw the distinction that you had in this question, which is to say we will underpin the integrity of the safe yield curve. So if there's a spike in demand or if there's a problem in the safe yield curve and people want to repo, government bonds or government securities to us, we'll do it at a price that stabilizes that yield curve. And that's the boundary then. That's where we draw the line. We're not going to control the credit risk premium in these alternative markets. Now, whether they'd be able to credibly stand by and watch the corporate bond market melt or the CP paper market melt, I don't know. But I think that is a pretty deep fundamental question, is what, market maker of last resort in government securities. It's hard for me to see why a central bank wouldn't do that. And it's hard for me to think about why you would say the only people we're willing to transact with would be primary dealers. So I think that's an important possibility, but I think you'd have a lot of work to do to convince the world that that's where you're going to now, having just seen us have that alphabet soup of all these programs. And as Ed was just saying, there'd be pressure for other strategic markets. And so even though I think that's the most easily drawn line, and there's good theory and a high principle that you'd have on your side, I'm not sure it's feasible.
Thank you. And Annette?
That's the thing about the Fed code issue of the central bank code. Having worked on the Fed code, I mean, this is not a new thing. We have seen the Fed code kick in many times. I think where we need to go is, as one of you brought up, like, how do we charge for the Fed code in good times? So when I teach MBAs, they always ask, why is there a tax advantage to debt? Maybe given all the various financial stability issues and the need for bailouts that seem to occur repeatedly from debt, it's time to revisit some of that tax deductibility of interest, which hopefully would have a calming effect on bond markets.
Thank you. Any final words, Annette? No? Any final words from Anil or Ed? I think I saw some heads shaking no.
No, thank you, though, for having us.
Thank you very much. So that includes our sessions for today. I'd now like to invite Senior Deputy Governor Carolyn Wilkins up to the podium to deliver the closing remarks.
It's clear from the discussion that we've made really good progress in our work, and I was pleased to hear there's a lot of comments, but there was also overall support for at least how we've approached it and the questions that we're posing. That said, it's also clear that there are perspectives yet to be considered, and there's some robustness checks to our model results that we'll want to do. Now, rather than summarizing the whole day's discussion, I thought I'd display the typical central bankers kind of going with the flow, as we like to do, being spontaneous, and just draw out some highlights and my first take on where our researchers should follow up. Now, these remarks will be edited and improved, and we will publish them in the coming days. So the first is the observation I would make is that the fact that our current inflation targeting framework has garnered a lot of support over the years is remarkable, recognizing that it's not perfect. I mean, we have a simple framework, it's flexible, it holds us accountable, and the credibility that it has brought has been hard-won, and it's invaluable. Now, in our morning sessions, we focused on the horse race and our side-by-side assessment of alternative frameworks. Now, the results that Reese Mendes reviewed are very rich in information, and I just really like to commend the staff, our researchers, for their work on this. Now, having been part of many renewals on our monetary policy frameworks, it was evident to me that theory is catching up a little bit to practice. The models that researchers are using are still imperfect, for sure, but they're richer along important dimensions. We can model different behaviors in terms of inflation expectations, and importantly, we can recognize that people are different in terms of income and in terms of their wealth. And we're increasingly going beyond the models, getting out of that rigid framework to assess how different frameworks would perform in the real world, talking to real people. Now, we saw that none of the frameworks that we looked at dominate across all the criteria that we brought to bear. However, some do much better than inflation targeting in some circumstances. Just as an example, targeting the price level does better at stabilizing prices when compared to our current framework. And this is particularly true at the effective lower bound on interest rates. That said, our experiments with real people found that these gains may actually not be realized because people often extrapolate from the past. We also found that it comes at a cost of worse outcomes when we consider stabilizing output or the distribution of income and wealth. And clearly, this is just one example, but it means that probably we can't have it all. And we're going to need to make trade-offs in our final decision on what framework we'll settle on with the federal government in 2021. Now, as a policymaker, I just can't emphasize enough how important it is to be transparent about the trade-offs that are ultimately made. And our horse race approach, with its clear criteria, will help us do just that. Already, we're able to better understand and clarify how our current framework works in practice. We have a single target, that's inflation, but we also take the output gap explicitly into account in the setting of interest rates. And Pierre Fortin recognized this in his remarks relating to the Bank of Canada's response to COVID. It also shows how our flexible inflation target is quite close to a dual mandate in which we would target both inflation and employment. It's therefore no surprise that the differences between the two frameworks are relatively small. The discussions found results of our research plausible and consistent with what's in the literature. That's good to hear. But there were some different views on which framework we should ultimately choose. Now, I found the discussions with respect to how to deal with the ELB, the effective lower bound, in the low inflation environment particularly interesting. One view was that, well, if we're in a low inflation trap, that we should raise the inflation target, or at least we should consider that. Well, we did consider that in 2016, and we found that the gains weren't big enough to make up for the adverse implications for inequality and potentially the credibility of our target. Another solution suggested was to consider probing or taking more risk that inflation could overshoot the target when inflation is low. And without implying any commitment to this idea, I think this approach is worth considering. And that's particularly given the uncertainty that we should admit that we have about how low unemployment can go before it leads to inflation pressures. There were also several helpful technical points raised by our discussants that are worth pursuing. Just a couple of examples here. Both Joe and Pierre encouraged us to pursue alternative relationships between unemployment and inflation. And we could do this through a nonlinear Phillips curve as an example and the degree of downward nominal wage rigidity. Stephanie suggested that we should look at how means or averages of key variables such as the output gap might change under different monetary policy frameworks. Of course, there's a pretty healthy debate about whether monetary policy actually does affect anything but the price level in the long run. She also asked us to see if our results on inequality are robust to different assumptions about fiscal policy. Now, I heard that great ideas were also discussed in the breakout sessions as well. In the afternoon session, we discussed policy coordination and the lessons from the COVID-19 crisis. We've seen that when interest rates are at or approaching the effective lower bound, fiscal policy, if it's implemented quickly, can be a powerful force in helping to stabilize the economy. Ricardo and Marty also emphasized the criticality of studying monetary policy frameworks in the context of the effective lower bound and a new reality of high debt. That's why fiscal policy and monetary policy interaction is one of the key questions that we are studying in conjunction with Finance Canada. In our discussion today, I found that their comments on the fiscal and monetary policy responses to COVID very interesting. They rightly raise some of the challenges that policymakers could face. As a community, we need to be thinking about the implications of a new environment for our monetary policy frameworks. That's clear. Also, clearly, is the fact that the recovery we're seeing is encouraging, but we know that it will take time and concerted policy efforts on many fronts to make up the ground that we've lost. And it is the right time now to think about how to build a strong economy in a post-COVID world, particularly given the challenges posed by high indebtedness. Policy coordination, while valuable, does raise governance issues for the central bank, who have operational independence for a very good reason. The lessons from history are clear that independent central banks do a better job of controlling inflation. Fortunately, we learned that from history. In Canada, we now have the benefit of the formal inflation control agreement between the Bank of Canada and the federal government that's renewed every 5 years. The fact that it has thrived over nearly 3 decades with many changes of government is testament to our joint commitment to our monetary policy framework and the economic well-being of Canadians. Amari suggested that in our 2021 agreement that we should look at how the fiscal authorities could clarify their role in supporting the inflation target, potentially through automatic stabilizers, among other suggestions. In our final session, we considered the lessons from the COVID crisis and the use of alternative monetary policy tools. Ed Devlin has come to the same conclusion as we have, that the central bank's new policy tools have helped improve market functioning and credit intermediation. But we agree with him that it's too early to see how effective these tools will ultimately be in achieving our inflation target. Now, there is some evidence in the literature from other central bank experiences in previous crises that the tools deployed at the effective lower bound did help support the economy and raise inflation rates. But with a lot going on at the same time, it's really difficult to get good estimates, and Anil pointed that out. He also pointed out, though, that it's much harder to generate growth when key parts of the financial markets are dislocated. And Anil's point about QE working through the exchange rate is consistent with research that we've done here at the Bank of Canada. I agree that there are important identification issues in trying to estimate the ultimate economic impacts, but that's what researchers are paid to do, to overcome those difficulties. Now, Annette walked us through some potential challenges with exit from quantitative easing that we'll want to better understand. Now, Ed's point that purchases of corporate bonds could create challenges as well just adds to this. Now, I'm going to take Annette's point that announcement effects can be powerful very seriously, and so you're going to understand that I won't reflect on the comments made in the last session or earlier today regarding monetary policy strategy. I will say, however, that the discussion only reinforced the importance of being transparent about what we're doing and why we're doing it. The importance of commitment to our inflation target and the importance of continued study and refinements of the tools to make them as effective as possible. So I'll just conclude by saying that the discussions today clearly illustrated that we are better informed than we were when we started in 2018, but it's still too early to draw firm conclusions. This workshop's really helped us refine the roadmap for the work that remains to be done for 2021, and our consultations will continue. And we will continue to solicit and welcome feedback from a much broader set of people than we have in the past. And I think that's very exciting, very positive. And you can look forward to more events and communications from us in the months ahead. So I encourage you to keep an eye on the special page on our website that's dedicated to the work on the renewal of Canada's monetary policy framework. Mais merci encore une fois de la part de mes collègues et moi-même pour une discussion très riche. And thanks for sharing your input today. Be well.
Thank you, Carolyn, for your remarks. I would also now like to thank all the session chairs, presenters, discussants, and the participants for virtually attending the 2020 Inflation Target Renewal Conference towards the 2021 renewal of the Bank of Canada's monetary policy framework. Thank you as well to everyone who has been involved in the planning and support of the conference in this new COVID era of meetings and conferences. This includes the conference planning team, audio-visual and webcasting support, graphics support, and administrative support. So this now concludes our day, and we hope to see you at the bank very soon. Have a wonderful evening.